Okay, can you all see the slide?
Not yet.
Can you see the slide? No?
Yes. Yes, we can.
You can. Okay, good. Thank you. Sorry. Nishan, මේ slide show එකේ යන්නේ නැහැ. One second. Here we try. Here, no? Okay. Window. Okay.
Yes.
This one.
Yeah.
Okay.
Now they can see.
No, slide show. Can I do a slide show?
Yes.
On top, right?
Yes.
Fine. Okay. Fine. Thank you. Okay, so we are starting off with a very broad area. We're starting off with the basics of banking and what is banking, and then we will drill down into what treasury does, and a bit about fund management and a bit about liquidity. I think, can I ask, since I've not met any of you, do you all are you all working now currently? Are you all looking for employment? Are you all currently working? What kind of background you all have? In general, is there anybody who is not in a bank or who is just out of university, out of other degrees looking for employment now?
Most of us are working, it seems.
Also, are you all working in banks itself, finance companies, banks, any other finance institution?
Lot of students work at banks, but there are students who work at finance companies as well.
Okay, great. So you all have a basic understanding about the banking sector and how it works, and maybe even more than that. Like I said, my apologies. I'm trying to understand the mix of the class. So if you don't understand, please feel free to ask any questions. So, I mean, we start off with a very basic question: what is a bank's function? And then we go on to treasury, like I said, and then fund management, liquidity. Uh, Basically, what we want you to be able to do at the end of this lesson is to be able to at least broadly recognize the function of a treasury and the importance of liquidity and managing your funds, and also a very light touch on a function of the central bank and what the central bank does within the economy, within the monetary system, within the banking system of a country. So what is a treasury? So by way of a background, I work at HSBC. I'm a head of of a desk in HSBC Treasury. And basically, I've been in banking for the last 27 years, and in a global markets treasury function for the last 20 years. So this is a question that a lot of people ask. Treasuries are not usually very big in terms of number of people, at least not in foreign banks. I think even in the local banks, local institutions, compared to the staff that you get in the institution itself, you find that the staff in the treasury function are very small, but they do have a very important role to play within that financial institution, whether that bank or whatever that financial institution is. The reason for having a small staff card is because you don't need a lot of staff, but you need to be able to understand and manage very complex situations, market-driven situations, as well as sometimes very high intense, stressful situations that you need to have people who understand the finance and who understand the capital markets and who understand how to manage those situations very well working in them. So by way of a practical example, my team in HSBC, we have at the moment, we have 8 people working in my treasury function. The maximum I've had working in the last 20 years being there, 23 years being there actually, sorry, is around 12 people at its maximum. But we account for around 30 to 40% of the bank's top line revenue, and we manage the bank's risks. So it's a very important function, but not by way of staff numbers, by way of the role of what it does. So the treasury in any company is given the responsibility of managing the bank's assets as well as bank's assets and liabilities, and also in most cases assisting its clients, the bank's clients, to manage their assets and liabilities as well. So in this case, we are looking at what the treasury does to manage the particular banks or financial institutions owned assets and liabilities, and we'll go into a bit of detail in that separately. So as you may be aware, different banks will have different functions. So we have the corporate banking function, we have retail banking. Various institutions call it various things. They call it, retail banking is called personal banking in some places. Corporate banking is called wholesale banking, or various names for that. And then treasury is called global markets. It's called treasury, various things. So treasury sits within one of the major functions of a bank, and its role mainly is to manage the assets and liabilities of a particular institution in the most efficient and compliant way of doing things. And I'll explain what that is to you later on. Just a statement there, quality of an organization's treasury impacts the success of the entire organization. Again, I'll explain that to you. The reason for that statement is that a lot of people look at a bank from what they can see on the outside. So meaning, how much do you pay on a deposit lending rate? How much are your exchange rates? How much do you charge for certain fees, etc., etc. But for the bank to be able to provide its customers with the most beneficial lending rate, deposit rate, fees sometimes, risk management solutions, various things. At the core of it, there has to be a function that allows neutral way of managing that risk within the bank, so that some of these can be actually benefits can be passed on to its customers as well as to the bank. Again, like I said, I'll go into detail afterwards. So we start off with the basics, like I said. What is the bank's function? Can I ask? I know it's early morning and probably all of you are sleeping on your bed or having a cup of tea, put me on mute and, barely listening to what I'm saying, but it's okay. Can I ask a question? What is the bank's function? What is a bank's function? Any volunteers?
Bank will collect deposits from the one who having the excess money, and it lend to customers where they have a deficit.
Okay, great. And that's it. Yeah, thank you very much. Sorry, I didn't get your name.
I'm Ruchira.
Ruchira, thanks, Ruchira. Thank you for participating. Anybody else? Anything else that you want to highlight?
It's a financial intermediation.
Very good. Yeah. And what do you mean by that?
I mean, you actually create a relationship between the supply and demand of money. I mean, you play a role of
very good
connecting supply and demand. Yeah.
So who sits on either side of that equation? if you have supply and demand,
yeah.
obviously clients sit on one side, but who's on the other side of that?
The same the another set of clients
Okay.
whose requirement is different from the previous one what you have mentioned. Yeah.
True. But you agree that central bank also could be using the banks as well?
Probably more or less we look like we are looking at them as a regulator here. I mean, they're monitoring how the banks are doing their role, the function. They also take a part of the process, but mainly a bank is involving in the financial intermediary process. That's
No, thanks. That's 100% correct. Why I said central bank, and we'll go into detail later on. But if you look at the way money supply happens, banks play a critical part in creating that money and creating M2 cash flow in rather money supply into the financial system as well. So there is a role that banks also play in that process as well. But yeah, more or less you're correct. So it's a basic thing. If you look at it, you deposit your money with a bank, as you said. Somebody doesn't have cash. He goes to the bank, collects that cash, and basically the bank sit in between, pay the depositor deposit rate, pay the lender or rather charge the lender rate, and basically pays out to his depositor. So obviously the bank, in a very crude and very basic sense, would make money on a margin on the deposits that they keep from the client, a margin on the lending that they keep for their people who borrow. So from a very basic banking perspective, the bank sits in the middle. And you mentioned that they serve as a finance intermediary. In that situation, the bank's function over the years has been the fact that depositors and lenders need a place to need somebody in between to underwrite the risk. So when I say underwrite the risk, meaning if I have money and one of you do not have cash, I can of course lend it to you directly. Say, look, here, I'll give you the cash, give me 10% for that. But obviously there is an element of trust. I may not know who you are. There's an element of risk that is taken when you lend cash like that. And even when the guy who's taking the money, to be fair, people always look at it from the point of view is the guy who is lending the money is taking the risk. But I would also challenge that the person who is actually taking the money these days also does take a risk. Why do I say that?
Because I believe that circumstances are such that they are not in a position to pay back, but they have borrowed. The circumstances are which is beyond their control.
So basically, they're not able to basically pay back. They might find financial difficulty. But there's also another element of it, and it's not in the slides, but just to share with you, financial crime. So if you are borrowing from somebody who has got that money from ill-gotten gains, from drug trafficking or from stolen cash, you being a person who has taken that money from somebody also will be accomplice to money laundering, basically in terms of cleaning up that money, whether you know it or not. So people who borrow money from people who don't, they are from intermediaries, from unknown people, are taking a crime risk in terms of financial crime as well, participating in a financial crime as well. So why does a bank come in? This is something very, if you look at it, this is something that has come in over the last few years. Why is a bank important for all of these reasons? One reason it's coming in is, yes, the trust and the financial risk that but this is the basic thing that we know about. Second thing would be that, look, the bank, when they take a deposit, they would screen the person they're taking the deposit from. They would make sure that he has a proper account open with the bank. That we ask the question, where did you get the money from? Yeah. And then put the money in the account. And then the guy who's lending doesn't bother about where that money is coming from. He's borrowing it from the bank. So he doesn't have to worry about those things. And like you mentioned, when the bank lends money, they screen the person they're lending it to based on his repayment capacity, based on his collateral and his ability to pay back that funding. The bank will lend the money. So basically, the bank sits in between. It's not a simple matter of somebody saying, we are borrowing deposits at 5%, lending to people at 15%. There's a huge function in between that the bank does, both for the depositors and for the lenders. And that is one of the reasons that there is a margin kept on either side of borrowing and lending to facilitate the amount of work that the bank needs to do and the risk the bank takes in terms of both sides of the equation. Is that clear?
Yes, sir.
Yes.
So if I go on to slide number 8, you can see it says investors, so depositors, serves as intermediary between investors and basically with the borrower's deficit and lends to people who need cash. But like I said, that's a very basic function. There are more, but I think for this purpose, we start off there. So if you take that and that flow that we decide, bank will take money from the depositors and basically lend money to the borrower. So like I said, now from there onwards, let's look at a flow of money. Let's just go back to let's go to slide 10. Slide 9. Stay there. If you look at a depositor who has given money to a bank, and now the bank has this cash with him. Say they have got the client on board. They made sure the deposit is perfect. They take it. They pay this guy 6% in terms of interest rates. Yeah, and now the deposit is sitting with the bank. Now for the bank to earn an interest on this and pay the depositor the 6%, the bank has to lend this money to somebody. One of its other clients. So the bank will go out there and say, okay, fine, I'm going to lend it out. So often the deposits are taken by the bank's retail banking unit. Corporate banking also would have it, but if you look at a majority of the deposits that a bank gets, it would come from retail banking clients or individual clients. Yes, of course, there are corporates like institutions like the insurance companies or pension funds of corporates who would generally also park their money with banks, and those will be big amounts. But if you look at the mass amount of numbers of volume of deposits, it will be from people like you and me who would go and deposit money in a bank. Now, when the bank has to decide, what shall I pay for these deposits? 6%, 5%, 9%, 8%. And then once I take that, what shall I lend this money out at? 12%, 13%, 14%. There is a role to play by somebody sitting in the middle of that whole transaction that will then say, okay, this is the rate that we can pay you. So I'll give you an example. You walk into the bank, you deposit your money. The teller at the bank or the customer service person at the bank will tell you, I can pay you 5% for your deposit. You will argue and say, no, I don't want 5%. I want something more. So the teller or the executive will call the Treasury department in most cases and say, there's a client, he has 10 million rupees. What can I get? What's the best rate I can give you? So the Treasury guy would then say, okay, fine, you can pay him up to 6%. And this guy will say, okay, fine, we'll pay you 6%. Now, for the guy in Treasury to make that decision, what would have dismayed? What is the knowledge he has to give something more than 5% for a deposit? Why do you think he made a decision to give a higher rate of interest for that?
There
Because
could be, yeah, there could be opportunity for him to relend it at a higher rate by keeping a margin.
Okay, very good. Thank you. Yeah. Anything else?
He would think that in future the interest rate will go up. Presuming that he can invest at a higher rate.
Very good. That's also correct. Okay, yeah, that's good answers. Thank you very much. Appreciate that. I think both those answers are correct. And also one more thing there, the bank could have a liquidity requirement of its own, where the bank at that particular time needs to borrow money, not to necessarily to lend it out, or not to necessarily to because it's expecting interest rates to pick up, but simply based on their own liquidity requirements, own funding requirements. They could have a requirement where they would like to pay a little bit higher for larger value transactions. So therefore, instead of paying the usual board rate of 5%, you might think, look, 6% can be done, and 6% is a good rate. So let's go with the 6% rate for this guy and try and win the deposit. Now, the people are sitting in the branch in the retail banking section are given a mandate to go up to a certain level. Usually each bank, or not usually, banks do have their own what we call a transfer pricing mechanism. So how it will work is, one second. So how it will work is, the Treasury department of a bank will sit in between these depositors, and then you'll tell that we'll sit sit and say, okay, this is the maximum we can pay you. The branch people will then say, okay, fine. Based on that, we will pay you X amount. Now, different banks share the profit on this deposit in different ways. So I will not go into that. But what you need to understand here is that the Treasury department is the department that determines what maximum level on the first leg of a lending that we can give a client. Okay. Then you go to the next one, where the borrower comes, somebody comes now and says, look, I want to lend corporate banking guy, relationship manager, lending officer, whoever you want to call it, comes up and says, I have a client who wants to borrow 100 million rupees. Now, that client is basically a good client of the bank. We have quoted him a rate of, say, 13%. Now, in lending, it's a little different because there is a margin kept on top of the lending rate to compensate for credit risk. Credit risk and the risk the bank takes in terms of the client not returning that money. So you have a credit risk based on the client's risk profile. So that credit risk could be with a margin of 1, 2, 3, 4, 5% above the lending rate given by the interbank lending rate, or the lending rate given by the department, in this case the Treasury department. So for example, a client, we could be lending to a client for 1 year at, we'll say, 14%. The Treasury department could be giving the client, the lending department, that money at 10%. The 4% represents the credit risk the bank is taking on the client who is borrowing the money. Now, the lending guy could come up to the Treasury department and say, look, you're quoting me 10% as my lending interbank rate for me to lend to my client. Can you please give me a better rate, because this is a really good client and I want to quote him a little better price. So the Treasury guy could turn around and say, yes, okay, I will give you 9%, not 10. Then that guy could get 9 and make his lending rate 13 from 14. Now, the the lending guy could also reduce his 4% down to 3 or 3.5% as well, separately. That is up to him based on the risk profile of the client. But what he's asking for from the Treasury Department person is for a reduction in the rate of the interbank rate, or the rate at which the client can borrow at from the market. That way, he can pass on that benefit, if anything, to the client. Is that clear? If it's not, I can repeat.
It was clear.
Yeah. So the Treasury Department sits in between and watches the market rate, watches what's happening in the interbank market, sees whether interest rates are going up, going down. Like one of you said earlier, he would judge whether it's a good time to borrow, good time to lend. Based on that, he would also watch the bank's liquidity situation, whether we need to lend more money out because we have surplus cash and therefore we don't mind lending, or whether we need to borrow money because we do not have cash and we need to make sure that we sort of stay liquid. They would decide that, and they would be the intermediary in between the bank, the deposit side and the lending side, the branch side and the borrowing side, and make sure that there is a independent evaluation of the risk the bank is taking by taking deposits and by lending money, and making sure that the in and out, the yields, the rates we pay meet the requirements of the bank, and that the bank is not losing out in between by borrowing and lending at unfavorable rates. So I will give you another example. I'm not sure how many of you are aware, but if you look back in Sri Lanka, we'll say, I would say about 10 years, 5 years ago, maybe a little less than 5 years ago, maybe, yeah, about 4 years ago, we were offering deposit rates to our clients. And if you are working in a finance company or a bank, you know this. If you are working in a branch, if you are working in a deposit area, you'll know this. I think sometimes the rates were as high as 20%. People were giving deposit rates as high as 20% for 3 years, 4 years, 5 years. Maybe 5 years ago, I can't remember exactly when. So basically, you could have got an annualized rate of 20% per annum for 5 years. So if you put 100 rupees now, and if it's 5 years, you get 200 rupees basically, roughly, very roughly, in 5 years' time. So 20% now. Currently, the deposit rate of a bank for 5 years is probably around 8, 9, 10%, something like that, maybe a little bit more. So if you look at it, interest rates from that time to now have halved. Now, the bank that borrowed that money from their depositors at 20% at that time for 5 years, we'll say it's still within the 5 years. Now they are committed to pay their depositors still at 20%. If the bank had not managed that funds that they borrowed at 20% and lent it out again, or used the funds in a more efficient manner, they would have a liability on their books right now at 20, and the assets they can generate, the lending they can give now, will be only at around 8 or 9%. If they had not done that, they have not used that funding wisely at that particular time, they would still have something that they are paying 20% for, which is a very high yielding liability that they have to manage. So that is where a bank's efficient treasury functions is important, to tell the guys, look, we should be borrowing at this rate for this period and managing those funds like this. If not, you would borrow money. One person will be borrowing money at one rate, another person will be lending money at another rate with no coordination in between. So that's one of the functions of Treasury. Second function is liquidity. So if you look at slide number 10, the coordination or management of funds, that is what I've just explained to you, what the Treasury does from that side. Other one is maintains liquidity and maximizes profit. What do I mean there? So basically, one function is about making sure that you are managing your funds most efficiently. Other one is to make sure you're liquid, meaning as a bank, if a depositor were to come and say, look, I want my money back, you should be in a position to give the depositor his money back to him. In order to do that, the bank should have enough of liquid assets, be its own deposits, treasury bills, whatever it might be, so that they can sort of say, okay, fine, here you go, it's your money, this is what we're giving back to you, and we give back the money. So the ability to give that back, say if there are 100,000 depositors and 50,000 guys come and say, I want my money back, for whatever reason, the bank has to be in a position to do that. And that means that the bank has to make sure it has enough of liquid assets in their position to liquidate and provide those money back to their depositors. Because if not, it is not meeting, it's not fulfilling its obligations to its clients, because the deposits are called demand deposits. All these accounts are demand accounts. Basically means that if a client comes and demands his money back, the bank has to give it back to the client. They cannot. Yes, they might charge early repayment fees or penal fees or whatever you want to call it, but the client's money has to be given back to them. And maintaining that liquidity for that kind of requirement is the Treasury's function, is to make sure there is enough of liquidity in the bank to provide that money back to its clients, and also to make sure that it is keeping up with the central bank's liquidity requirements as well. In the process of doing all this, managing the funds, providing liquidity, managing its clients' funds, the core of it, Treasury is not a cost center. It is a profit center. In other words, it has to do all this and also manage its own P&L, its own profit. So meaning the guys in the branches make their own profit, the guys in the lending department make their own profits, Treasury makes its own profit. So it's not just a service or cost center. It is a profit center, at least for the banks. Is that clear? Please do ask, because I'm not sure whether I'm going too fast. If I am, I'm happy to slow down a bit.
It's clear.
It was clear, but one question.
Yes, please.
As you mentioned, this management of the fund, you said Treasury need to manage long-term funds. Maybe you might take deposit for 5 years, but accordingly you have to invest for that reason. What are the tools Treasury used to identify that? Maybe gap analysis or something like that. Or how are you going to identify that gap? Like what is the procedure?
So that's a good question. I think what happens there is, say if I take a deposit for 5 years, and the decision on taking a deposit for 5 years or whether the bank should be taking or not will become what we call an ALCO decision. Asset and Liability Committee of the bank, they will decide how long they can actually go for deposit, 5 years, 10 years, whatever, because that's a bank-wide decision that's taken. Once the bank decides they're going to take take a 5-year deposit, then there'll be an assessment on what rates that they can take at. So what Treasury will do is, Treasury will have a transfer pricing policy, and they'll say, okay, for 5 years, based on the current market, we can quote you 21% for if you raise deposits, Treasury can quote you 21%. The branches will then, okay, Treasury is quoting the branch, because the branch within the bank, Treasury and retail work as two separate units. Our Treasury and the lending department work as separate units. So Treasury will pay the deposit bank section, say 21% for 5-year deposits. Then the deposit section will go out there and say, okay, fine, we are getting 21% from Treasury. We will go and borrow at 19%, 18%, 17%, 20%, wherever they feel they can generate that income. Now, for Treasury to give 21%, that is what you're asking me now, to do a gap analysis, they have a few things. Number one, they will think, okay, I can, this is an extreme example, so I'm just giving you a very broad thing, right? They could think, okay, there's a 5-year Treasury bill I can buy at 20%, 22%. Then I will go out and buy that 5-year Treasury bill at 22%. So whatever deposits I get at 21, I'll manage it by buying a Treasury bill at 22%. Or there could be a corporate client who wants to borrow from me at 25%. So we know that there is a liquidity requirement, there is a funding requirement like that. So we as a Treasury, I'm happy to go and manage that and borrow that money and give it at that level. Or we could have interbank counterparties who are willing to do a foreign exchange swaps or whatever it is. I won't go into detail on how that works, but which basically give us the ability to lend money at 25% or whatever it is. So we go ahead and we will do that. The other thing that can happen is that even if we borrow, we'll say, and 5-year may not be a good example for that. So we'll say we'll do short term. We decide to pay 20% for 3-month deposits, right? Because we have a liquidity requirement. But we may not have a lending for 3 months or even 5 years or whatever. But we need to have a liquidity requirement for 3 months. So only for that 3 months, we say, okay, we'll go up to 20%, not because of interest rates, but the bank has a liquidity requirement. So Treasury will pay the depositors, pay the deposit section 20% for 3-month deposits. Those guys for that period will go out and borrow. They don't take a risk. It's the Treasury department that takes the risk. Why is Treasury willing to pay 20%? Because they realize that the bank has a liquidity requirement and they need to manage that. So they need to pay a higher rate to get those. And sometimes what they borrow at 20% for 3 months, they don't necessarily have a lending option for that yield at that point in time. So what they do is they have a gap in terms of borrowing for say 1 year, lending, borrowing for say 3 years or 4 years or 2-3 years, and they are only lending for 1 year or 1.5 years. So they take the risk in terms of a gap risk. Why are they doing that? Because, like I said, they have a liquidity requirement, and also it could also be a case where they actually have a view on interest rates that they want to materialize. So whenever there are high deposit rates paid, at least in Sri Lanka, you will find that there aren't lending rates that high as well. So the banks are usually paying high deposit rates in Sri Lanka, at least where local market is concerned, because of liquidity requirements rather than because they have lending opportunities at those levels. So it's because of the second point rather than the first point in your slides. It's because of that. But if you find that deposit rates come down, say currently, for example, T-bill rates are around 6%. Here you will find that there will be a lot more clients who are looking to borrow long term. And here the banks, I think, would be, how can I say, again, a little reluctant to lend at these levels for long term, maybe because if the interest rates go up, they'll have to borrow deposits again at high yields. And at these current levels, I don't think anybody is looking to put 5-year deposits at 5% or 6% or 7%. So most often you find in Sri Lanka, it is very short-term rates that banks can deal with. If it's long-term and they are paying high yields, it's often because of a liquidity requirement. And the gap analysis comes not only because of instruments they can use, but based on the liquidity they need also. Not necessarily because they have instruments that perfectly match the deposits and lending. It is either a liquidity requirement or very specific requirement that they have that they want to meet. Okay, I hope that answers the question.
Yeah, it was clear. That means each and every bank might set up gap limits, and they monitor the gap limits. If they are within the gap limit, in the sense Treasury supposed to manage the fund accordingly, or if there is a mismatch in gap, means there is a issue. Like just a
Yes.
quick answer for
Yeah.
that.
That's correct. What happens is the Treasury Department will sit in the between and see what that gap is. The gap is not managed by the lending or branch. The gap is usually managed by Treasury, who sits inside the ALM or ALCO department of the bank. They will advise them, this is where we are at, these are the risks we are running, right? And they will manage that gap. So yes, you're right. There could be a situation where the bank has 5-year deposits at 20% and is now lending at 10% or 9% to their lenders, and they still have those deposits on their book. And there is a risk there, and there is a negative P&L that the bank accrues because of that. But that is a risk the Treasury has to take, and that is a P&L hit that they have to take, or ALCO or ALM or whatever you call it will have to take that negative P&L impact onto their books. But that analysis and that decision and advising on how we proceed is done by the Treasury function. Yes, correct.
Thank you, sir. Thanks.
Okay, thank you. Any more questions? Okay, so I'll go to the next one. So I've covered a lot of these, but already, but I'll just go through it. So Treasury manages clients' markets products in order to provide funds to meet their the bank's obligation to deposits, like I meant in terms of liquidity. Help borrowers and issuers raise funds, so basically providing liquidity to their clients who want to borrow money. Reduce assets on the bank's balance sheet and supply investors with investment alternatives. Yes. Maximize the bank's profit through trading and sales. Increase fee income through deal structuring. Now, the last two I have not touched on, but I will basically touch on that now. So basically, what I spoke about earlier, all what we've discussed so far, has been about what a treasury does for the bank itself, for depositors, for lenders, by virtue of the bank depositing the clients with depositing money and lending money, how the Treasury Department manages the risk, and how the Treasury Department basically provides the liquidity for the bank. Now, in addition to that, the bank also, the Treasury also helps the bank profit by assisting its clients in managing their risk. So in other words, and also by having a trading function as well. So the Treasury has two sections. It has three sections actually. It has what we call, broadly it has what we call a global markets section. Global markets is basically what we have: trading and sales. Trading and sales sit separately, and they manage the bank. The trading side will basically use the resources they have to monetize a view on interest rates, to monetize a view on exchange rate, to monetize a view on a commodity, and basically generate income from the bank by doing that. The sales side would have no trading mandate. They cannot trade, but what they can do is they can use their knowledge, the products they have, to help clients to manage their risk, be it in foreign exchange, be it in interest rates, be it in commodities, whatever it might be, right? The sales side also would help the bank generate an income by fees. So by structuring transactions that allow a client to borrow money, that allow a client to manage their risk in terms of their underlying asset. So this is a product, this is a function of the Treasury Department outside of its function of managing the bank's own risk. That's one thing. So I said there are three sections. So two sections within global markets, trading and sales, and the third section is we call balance sheet management, BSM, or in some banks they call it ALM, asset and liability management. So that function sits within ALCO, assets and liability committee of the bank. They help to manage what we discussed, the gap analysis of the bank. They help to manage the liquidity of the bank. They help to manage what the transfer pricing, deposits, lending, all that. banks, capital requirements, all that is managed from the Assets and Liability Committee. But make no mistake, they also have a profit orientation. So in other words, the Assets and Liability Committee, ALM department or BSM department, balance sheet management, they need to make sure by doing all that, they also get increase, they also have profit made for the bank. Is that clear?
Yes.
Okay, so before I go into the next one, so I'll just recap on this, right? We learned about Treasury. We learned how a Treasury sits in between a bank and helps the bank to achieve its functions of the basic functions of managing the risk between its depositors and investors, lenders, the bank people lend to. We also learned that basically the Treasury has not only that management function, but also to manage the liquidity of the bank. And now we just learn that the Treasury also has a trading sales function as well. Outside of that, to make a profit on trading activities as well as sales activities of products and fee structuring to their clients. So basically continuing on from what we discussed. So interest rate exposure basically. Now we go down to what we call the asset classes. So when I say asset classes, I'm referring to the underlying asset that is being managed by the bank. So in this case, in most countries and in 90% of the world, the two biggest assets that are managed are interest rates and foreign exchange. Then you have other asset classes like commodities and equities as asset classes separately. But in the more developed world, you have all of those being managed. In Sri Lanka, the two main asset classes that are managed by the financial institutions are interest rates and foreign exchange. So basically for interest rates, you have short-term interest rates, long-term interest, which is very short-term by definition is usually below 1 year. So money markets, treasury bills all fall into that short-term interest rate management bit, product-wise. Long-term is anything beyond a year. So treasury bonds, debentures, all that fall in corporate debt that are long-term, all fall into the long-term interest rate management, the product side. Foreign exchange, we have two. Basically, you have a transaction level. So basically, importers, exporters, inward remittances of some sort, outward remittances of some sort. All that are transactions that take place on a daily basis. The foreign exchange market is the largest market in the world. It spans every geography, and it goes into trillions and trillions of dollars of trades every day. Translation risk is also related to foreign exchange, and it is basically where your reporting currency and your functional currency could be different. So for example, if you have, we'll say, a UK company that's set up in Sri Lanka, and they need to report their profit to the UK, at the end of every year, financial year or whatever their reporting year is, they will have to take their Sri Lankan rupee balance sheet, profit, income statement, and they have to restate that in the currency that they report into, in this case, pounds, sterling pounds. If by any chance the sterling exchange rate has appreciated or depreciated, depending on that, say for example, at the beginning of the year, it was 200 rupees. At the end of the year, it's 230 rupees. That means it has depreciated by 15%. That means on their profits that they make in Sri Lanka, they have a translation risk because of the foreign exchange movement of 15% negative. So the question is, how can a customer manage that risk? Is there a way of them doing that? Transaction risk is straightforward because it's about him knowing he has a requirement and deciding whether he has to hedge that requirement or not. Translation is a little more complex, and the products used also may not be readily available depending on the market you are in to manage that kind of risk. Is that clear?
Yeah.
Okay. And the banking relationship point there is basically that the Treasury function usually deals directly with all the banks as their interbank counterparties. So one of the primary areas that has direct contact with banking relationships. So basically, I sit and I would have direct relationship with my colleagues at HNB or Bank of Ceylon or Commercial Bank. We'll know each other very well because we deal with each other on a day-to-day basis. So we have probably the closest contact to our interbank counterparts than any other part of the bank. Because we deal there in a way, each bank is each bank's client. So Treasury basically is one of the areas that has very close contact with all the bank personnel in that particular function or in the country. So
One question.
Please go ahead.
What are the tools available to manage the translation? Say, if we are having a branch at Bangladesh, and then there may be a profit generated from there in your dollars, as an example. In such a scenario, what are the tools available to manage the translation risk?
Yes, very good question. And but what happens is this: most countries, like for example, you're talking about Bangladesh. You have Bangladesh, India, are restricted currencies. So in a regime where we have restricted currencies, you have particular products that you can use and particular transactions you can use those products for. So as you know, right now in Sri Lanka, all imports have been restricted, banned because of the current situation and foreign need to save foreign exchange. Like that, on an ongoing basis also, our capital accounts are also closed. So you can't really, unlike a developed market, you can't really go out there and do anything you want. It has to have some sort of underlying requirement before you go out and do products. So import exports is pretty straightforward. Transaction is pretty straightforward. But translation, generally, if you are sitting in a developed market, I don't think Bangladesh, unfortunately, is not a good example, and I don't think you can do much there. But if you are sitting, for say, in the UK or US, one of the tools you can use is currency options. So if you have the ability to buy, have you done a session on derivatives already?
Not that, I guess.
Okay, so without going into the products, but in detail, just to explain, if you want to hedge, you say you're expecting, you say you can do it in Sri Lanka, and the same example I use of the British company. If they want to hedge their sterling rupee risk, they can buy an option to buy sterling from us at 200 rupees in a year's time, irrespective of where the sterling to rupee rate is at that time. So if sterling is 250, they still buy it at 200. If the sterling is 180 rupees, where they can buy it at a cheaper rate than where it started off at the beginning of the year, they will walk away from the contract. It's not an obligation; it's just a option they buy. Currency options. If they use currency options, they can do that. But to buy that option, what we call a call option, sterling call option, they would have to pay a premium for that. So the choice the company has is that do they want to pay that premium at the beginning of the year or at some time in the year to purchase that option to buy the sterling in 1 year's time at 200 rupees. Then they have to build that premium, and what that premium is against the possible depreciation of the currency and the loss they'll make against that. But currency options can be used as a way of managing translation risk by way of premium paying currency options, by what we call puts and calls together, and get the zero cost currency options. Either way, they could use that as a tool. But access to those products may not be easy, depending on the market you're in.
Okay. Basically, option is a right to buy your note, no?
That's right. It's not a forward contract. Forward contract is obligation. Option
Yeah.
is it's option basically. It's not obligation.
Okay. Thanks.
Thank you. Thank you for the question. So, like I said, you have all these what I'm talking about. We've already discussed. Slide number 13. Cash and working capital management, cash flow forecasting, management reporting, controls, and authorities. So basically, all these come into managing liquidity, managing funds of the bank, and basically reporting those to ALCO and other related committees. So now we come down to, so like I said, it's 9:35 now. We'll take a break at 10 o'clock. But let's see how it goes. Are you all okay for that? 10 is all right?
Okay.
Yeah, thank you. So the treasury, the markets that they deal in. So basically now we discussed the functions. Now we come down to more detail on the where treasury actually where they would actually go to manage the risk and manage the liquidity. Where would they go to? So like in any economic function or economic situation, there is a market. Now, if you want to buy fish, you go to the fish market. There will be a fish monger or fish seller, and there will be a customer. You go there, you buy your fish and come back. If you go to buy gold, there will be a gold market, and you go to the market, you pick what you want, and you come off. You want to buy vehicles, either there will be car sales down one road or something. You go, you pick up your vehicle you want, you pay for it, and come back. So everything has a market. So in this case, Treasury also needs to go into a market to buy and sell, to trade the product that they need to use to manage their risk and to basically manage the risk of the bank and to maximize on profits for the bank. So what are the markets they use? So money market. Like I said, money markets are usually markets that are below 1 year. So you have a domestic money market, foreign market, which is self-explanatory, which basically means domestic is in the country, foreign is outside the country. Domestic would be in the local currency of that country. Can also be in a foreign currency, but it's often in the domestic currency. Foreign will be in the currency of the country that you're dealing in, or another major currency that is dealt around the world. So for example, you can do euro transactions in US, but US will be US dollars. You can do sterling transactions, sterling in the UK, but you can also do US dollar transactions in the UK because those are major currencies. Capital markets are basically anything beyond 1 year are capital markets. Why is it called a domestic? Same definition as the money market. Why they are called capital markets is because if you look at the term capital, these are markets that are used for people to generate capital. So long-term funding or long-term basically management of funds. So you're talking about 3 years, 4 years, 5 years, 6 years, 10 years. The US has a treasury that is 30 years. So these capital market instruments in developed markets go up to 30 years. In Sri Lanka, we had a bond that went up to 15 years, I think. But in Sri Lanka, capital markets are usually liquid and active up to around 5 years in the domestic market. Foreign exchange market, like we discussed, Sri Lanka has a foreign exchange market which basically has around 26 banks active in it. It is predominantly the basis of the foreign exchange market in Sri Lanka is dollar rupee. It's dealt with the dollar rupee. And basically it is mainly to facilitate trade and capital requirements for investors in bonds and equity, and to manage corporate risk in terms of the trade flows that the country has. Derivative market basically is derivatives are, how can I say, derived from the underlying transaction that you're in. So, for example, foreign exchange has a derivative market. They are instruments that help you to manage your risk in that particular commodity asset class. Like I mentioned, if it's interest rates, you have different derivatives to manage that. If you have FX, you have different derivatives to manage that. So forward contracts are derivatives, options are derivatives, swaps are interest rate swaps, etc., are derivatives. How complex the derivative is will depend on the tenor of the product you're doing, and also the complexity of the instruments themselves that it goes into. But derivative markets are also there. Sri Lanka does not have an active derivative market at the moment. Commodity market is basically, gold, oil, cotton, other precious metals, all that falls into the commodity markets. So Sri Lanka also does not have a commodity market, but in countries where there are a lot of commodities and where they trade, so usually commodities are traded from the central hub. So Singapore, Dubai, London would have commodity markets, like a trading desk with commodities mandate. And those countries would trade in oil. So, for example, Australia is a big exporter of iron ore. So they would want to go into the commodity market and to manage the price they pay for iron ore. If they feel iron ore prices are going up, they will want to go and hedge that risk by going and buying futures. Just to give you an example, if you have been following the news, you know that about 1 month ago, oil prices fell below zero for the first time in history. So they were into minus territory. So now anybody who had actually gone in and done futures contracts or contracts in the commodities market to buy these contracts will, in the next 3-4 years, be buying oil at below zero if they've done that and hedge their risk at those levels. So the opportunity is there because there's a market, and these markets are created by buyers and sellers for various reasons. But there is a commodities market as well. So everything there is a market for, and basically Treasury works within that market. So domestic market. So like I said, domestic market is a market in which the money is borrowed and lent for a short period of time. Yeah, so this is obvious. Domestic market trade in a local currency and are subject to regulations governing those domestic markets. Foreign market, if a currency is borrowed or loaned outside the country of that currency, for short, it is traded in the foreign market. Foreign market allows funds in any currency to be traded outside the regulations governing domestic. So, for example, if a Sri Lankan company wanted to borrow dollars for 6 months, but we don't have the dollars in Sri Lanka for them to borrow, within what we call the foreign currency banking unit and within the bank's own mandate, they can go out to, say, a bank in UK and say, look, I need some dollars, can you lend me? The bank in the UK might have lending limits to us. It's Bank of Ceylon, HMB, HSBC, whatever it is, and say, okay, fine, we'll lend you. How much you want? $2 million, fine, $2 million done. And they can basically borrow. Now that borrowing comes from the local bank's ability to go to that foreign bank and borrow. Once they borrow the money will come back to Sri Lanka. Come to Sri Lanka, sit in the bank's balance sheet here. But the funding and the lending has come from the bank in a different market, a foreign market, not from the Sri Lankan market. And the liquidity for the bank comes from the foreign market, not from the Sri Lankan market. So they are governed by the regulations in that particular market, basically. Domestic capital markets is a market in which bond is borrowed for long periods. Like I said, anything beyond a year generally is capital markets. And basically, who uses these markets? Okay, so just to stay there for a while, if you look at domestic markets, in Sri Lanka, domestic markets, capital markets are predominantly treasury bonds. Treasury bonds go up starting off from 2 years, goes up to, like I said, 15 years, but are usually liquid and available for 5 years. So who uses capital markets? If I can stop there and ask a question. Who would be the main users of capital markets? Domestic capital markets.
Banks?
Yes, banks, for sure. Who else?
Maybe finance companies?
Finance companies, yes, that's right. Could be.
Could be. Maybe
Anybody else? One of the biggest.
investors?
Sorry.
Investors?
Yes, long-term investors. What kind of investors?
Treasury bond like that?
No, that's a product. What kind
Okay.
of people want to buy that?
Institutional investors.
Very good. So when you say institution, who are you referring to?
Basically, big corporate entities.
Not
Customers.
could be, but more important than that, who are the most active in Sri Lanka and anywhere in the world? Who are the most active participants as investors in the capital markets?
Primary dealers.
Primary dealers are in between people. They deal for profit, but I'm talking about genuine, real investors.
Provident funds.
Very good. So what you say? Pension funds, provident funds, insurance companies, who need to lock in their money for long term, because look at what their underlying business is, right? They have their clients who are insurance. You and I have insurance, or we have a pension fund. We'll say we are looking at long term, right? We need to park those funds for 20 years or 15 years or 25 years on a life policy, whatever. So they have long term money. So they have long term liabilities created on their book. They need a long term asset. So for them to be able to have a long-term asset, they have to find instruments that they can invest in that are as different durations. They can't put all their money in a 20-year treasury bond, 15-year or whatever. At the same time, they can't put all their money in a 1-year treasury bill. They have to manage their funds in a way that they have enough money to pay whatever claims that come to them, and at the same time generate enough income to pay their policyholders and to make sure they have a sufficient return being given to the fund, whether it's a pension fund or it's a mutual fund or whatever you want to call it. So those guys would be one of the biggest participants in the capital market. And they are the ones who would basically, so if you look at, say, for Sri Lanka, Provident Fund, employee EPF, they would be one of the biggest participants in the domestic capital market in terms of participating in T-bond auctions and T-bill auctions and so on. And basically banks would be the same. But like you said, primary dealers, banks, all that would be more intermediaries where they would often trade for profit, where they would take a view on interest rates. Say buy a treasury bond when it's 12%, when it goes down to 10%, sell it and make a capital gain. So they're not necessarily trading for their own. They're trading for their own book, but they're not trading necessarily for a genuine investment they have in terms of fund for their end client. They're doing it for profit. But genuine investors are the pensions and they are the biggest participants in the domestic capital markets in terms of interest rates specifically. Yeah. Okay. So basically, we have the person who is buying these instruments. We have the people who are selling. So selling, if you are buying a treasury bond, you could be an insurance company buying a treasury bond. The guy who's selling the treasury bond could be another insurance company who needs the money. It could be a bank who needs the liquidity. It could be one of these investors who has bought it and is now crystallizing it for profit. So foreign capital markets, again, I'll give you an example. If you have the most liquid capital and the most sought after is the US Treasury bills, which goes up to 30 years. In times of uncertainty and when people want to keep their money secure, one of the most sought after assets is that. So people will buy a 30-year bond, a 10-year bond, a 15-year bond, a 2-year, 5-year, depending on where they want to park their money in US Treasuries, and basically keep their money there because they feel it's a safe place to keep their money short term or long term, and then based on the risk assessment they take, step out of that requirement if they don't need it anymore. Now, outside of that, you have others who will also, like Sri Lanka, will go out into the foreign capital markets and raise debt. Other countries also will do that. They can raise it in dollars. They can raise, they'll call it euro bonds. They can go to China and raise it in renminbi. They'll call it a panda bond. They'll go to Japan and they will raise bonds there in Japanese yen. They'll call that a samurai bond. So they can raise it using the capital markets in those particular countries. They can raise it in those countries for their own purposes, but in the currency of the country they are in euro dollars, in US dollars or other currencies also possible, but they can use the funding coming in from a foreign market, but not in the local currency. Basically, in this case, Sri Lanka rupees. So, capital markets functions, raising of capital, the marketplace, so it helps borrowers and lenders, buyers and sellers to meet. Basically, stock market, it's the same thing. It's part of the capital market. The bond market, part of the capital market. Consists of a primary market and secondary market. So what does that mean? So primary market, can somebody say what a primary market and secondary market is?
Primary market where initially you purchase a particular stock.
Sorry, it was not clear. Can you repeat? Sorry, it was not clear.
Primary market where initially you can buy stock.
Okay.
Maybe first time issue shares and quotation bill. But when it comes to secondary market, it's obviously you can buy and share at secondary market. Like
okay. So yes, who has access to the primary market?
Maybe primary dealers.
Very good. And banks and primary dealers. So basically, primary market is usually where the first time issuance, right? So it could be treasury bills issued by the Central Bank of Sri Lanka or other central bank, depending on where you are. It could be the first time issuance of a T-bond, corporate bond or something like that. So you're buying it from the primary issuance, yeah. And then secondary market is when it starts trading on an ongoing basis from the initial buyer. He can basically trade it out and it gets started trading on the secondary market. Now, I have a question here. What is required for an active secondary market to be in place? Now, I think I mentioned a few times now that Sri Lankan treasury bonds go up to 15 years, but we have liquidity up to 5 years. Basically meaning, what am I saying there? Well, I'm saying that we have a secondary market, we have primary market bills that have been issued up to 15 years at some point. But if you look at the secondary market, the activity in the secondary market is usually liquid, or we are active in the secondary market maybe up to around 5 years. The reason for that is buyers and sellers have to be comfortable with the security that they are trading for various reasons. It could be the term of the security, it could be the yield is trading at, it could be that particular maturity of that persistent. There is no real reason. But the secondary market success for an instrument, for a product that is there, will depend a lot on how people feel about that instrument based on how it's issued. So if I buy a 15-year treasury bill in Sri Lankan rupees, I can be guaranteed that it will not be liquid. In other words, I would buy from the primary market and there will be virtually no secondary market for it. I will basically hold on to that bill, and maybe if I'm lucky, I might find somebody to buy it. If not, I will have to hold on for a long-term investment. I'll give you an example for that. Vehicles. If you buy a Ferrari today and you buy a Toyota Corolla today, which one do you think will, that's a primary market. You buy it from Ferrari, you buy it from Italy, Toyota, you buy it from Japan. You bring both down to Sri Lanka, right? Forget the price you paid for it for a second. You just buy both and they're sitting now in your garage. If you want to sell it, which one do you think you can sell faster? Exactly. And which
Toyota.
one do you think you'll get a good price for? Not the price you bought it at, but compared to the price, okay, compared to the price you bought it at, where do you think you'll get a better price? Now, one is getting a buyer, but where do you think you'll get a good price for? Where you will make money or not lose money? Toyota. Because ultimately, the Toyota has a good secondary market. So it basically has the same applies for instruments in the capital markets as well. So whatever you buy it at in the primary market, you have to make sure you know the purpose of it. And if you are looking for an actively traded secondary market instrument, then you have to basically be careful what you go and pick up in the primary market. Is that clear?
Yes. Yes, sir.
Thank you. So basically, foreign exchange market is the market in which contracts are made to exchange one currency for another, either spot or forward. So you all have done foreign exchange, right? Nishanta said that you completed that.
Yes.
Okay. So foreign exchange market is where basically exchange is traded, as it says here. So in Sri Lanka, foreign exchange mainly trades on dollar against the rupee. Okay, so I'll stop there for the moment. We'll start on financial markets after a little break. It's 5 minutes to 10 o'clock now. So can we restart, we'll say, in about 10 minutes? Is that okay? About 10:10?
Okay, no? Okay.
Okay, great. Thanks a lot. 10:10, I'll restart. Yeah? Thank you very much. Earlier, we've covered areas around Treasury and the functions of the Treasury. We've covered areas on capital markets and money markets. We've covered areas on how the banking sector operates, and now we're basically continuing on from there into and also basically from there what the money market does, what the capital market does, etc. So we went into some detail on the foreign exchange market, on the finance, on the functions of the foreign market and the instruments people use briefly. Now we are going to start off on the finance. Sorry, one second. We are going to start off on the financial markets bit of it. So on your slides, it would come as slide 21. So from a financial market perspective, like I said earlier, just going into those markets once more, you have the money markets. It's used for transferring of fund liquidity for basically short-term financing requirements of companies, of individuals, of institutions, basically. And basically, it's used for people to manage their liquidity on a day in and day out basis. Currency market is mainly to facilitate international trade, import exports, and for the ability for clients and people to be able to manage their foreign exchange risk as a result of the trading activity or the international trade that they undertake. The derivative market is basically used to hedge the risk coming out of interest rates, coming out of foreign exchange, coming out of commodities, and basically provides the institutions in the market with instruments they can use to manage the risk that they have from trading and doing their day-to-day activity. Commodity market, same as interest rates of foreign, a different market that you can trade your commodities in. So these are few of the markets that make up the financial market. You also have the capital market there, which is not mentioned, but it's also integral part of the financial market. So now we are looking at something called fund management. Yeah. So fund management basically is how the bank would manage its funds. So we spoke about deposits, we spoke about lending, we spoke about how the Treasury has to basically look at their what rates and what tenors they would like to borrow at and lend at and why that is. Now, when you consider how a Treasury makes the decision, this question was asked by one of you, what the Treasury does, how a Treasury would determine how they would determine their lending rates, how they would determine their borrowing rates, how would they determine their tenor. So the variables that come into it are those things basically. How much are you looking to borrow? What tenor are you looking to give it to us at? Borrow from us at? What currency do you want to borrow at? And then basically based on that, we have to take an assessment of the risk of that tenor, of that currency, of that amount. And risk against how can we maximize on that as well as manage the risk. So the variables that some Treasury would consider when borrowing, lending, taking a decision on rates, etc., would be that what amount, what tenor, what currency, and how we manage the risk. So amount. So as it says, you have an asset on your books right now where you have lent money to somebody at say $100 million rupees to somebody. At the moment, you have liabilities on your book of 50 million, but you need to raise more liabilities because you feel there might be a short-term requirement for you to fund that asset. What would you do? You would go out and you would raise liabilities which are deposits as a bank. So basically that decision, the amounts of assets and the amount of liabilities to make sure the bank has enough liquidity in its books and it's maximizing its mix between assets and liabilities to the best possible outcome for the bank, that decision is taken from Treasury. And that assessment, that analysis, that gap analysis, if you want to call it that, is done by the Treasury Department. And they are the ones who will ensure it's the most efficient combination that takes place. Tenor. Again, somebody asked this question, whether we are in a position to borrow 5 years and lend for 1 year, borrow 5 years and lend for 5 years, borrow 5 years and lend for 3 years, or borrow 5 years and keep lending it overnight. So I'll give you an example. Some people who are, say, primary dealers who have an active trading book in terms of Treasury bonds would buy a 5-year bond at, we'll say, 10% as an example. Fund that 5-year bond by borrowing in the money market on 1 week repo or 1 week money market rates at, say, 6 or 7%. So in other words, they bought an instrument that is 12%. and they're funding it every day at 6%, 7%. Now, you can say, oh, that's fantastic. You can do that every time. But what is the risk the guy is running? Can somebody tell me what the risk somebody does in that? So I'll give you the example again. He borrows, he lends 5 years at 12% to his investor. So basically buys a treasury bill at 10% from a person who's issued a treasury bill. And then he goes out to the money market daily and borrows that money to fund that investment at 6%. And he's making a 4% gain. What is the risk he runs? There is a tenor mismatch there. 5 years against overnight. What's the risk he runs?
Money market borrowing rate can be increased.
That's right. So the
During the
6%
tenor of 5.
borrowing rate can go up. That's what you're saying.
Yes.
Okay. Very good. What is the other risk he runs?
We lend to a person, he couldn't make his obligation on time.
We lend, so now we have bought a treasury bill already, so we have the treasury bill already. Okay, so
right,
now we need to fund.
This is a treasury bill. Yeah. Loan that is not relevant. Yeah. Okay.
The other risk we run, thank you for that answer. The other risk we run, one is what you just said. Yes, the interest rates that 6% goes to 15%. Then what you bought at 10%, immediately you're losing money on it on a day-to-day basis. The other risk you run is liquidity. Is that, for example, if you cannot access your money market funds because there aren't any people willing to lend money to you anymore for whatever reason, your credit quality drops, your there is no liquidity in the market because there's shortfall of money in the market, and it's very difficult to get liquidity, and banks are not lending to each other, and it's very tight. Depositors aren't willing to give you money because again, there's people are risk averse for whatever reason. Then you might have a situation where you have bought an asset which is 10%, and now you have no way of funding that on a day-to-day basis because there is no funding, there is no money. Simply put, there is no money. Then you have to go out, then you are forced to sell your asset and raise your liquidity, because if not, you're going to be breaching various ratios and regulations by not doing that. So by doing this, as long as you know where your risks are and you can manage the risk, it's fine. You will always sort of, depending on what we call the shape of the yield curve, you will make money. But you always have to run the risk that this situation can change again. That's why tenor management and timing of cash flows is important for fund management. Now, this is what I just explained to you. A gap in the money market transaction is period between the maturity of placements of loans and maturity of borrowings and deposits of each currency. So, same thing I mentioned to you on interest rates. It works in the money market in all instruments. So, foreign exchange market. In the foreign exchange market, a gap is the period between the maturity of the purchase and the maturity of the sale. So, foreign exchange is a little more complex. Generally, for foreign exchange, whenever there is a foreign exchange risk created, you have to go out there and hedge that risk. So there are very few gaps in between purchases and sales, because all these risks are at the time the risk is created, you basically will go out and manage that risk. So, for example, if you are an importer of a vehicle, you come to a bank and say, I want to buy $1 million, a million pound yen to bring down a vehicle. The bank will go out and buy that pound immediately, million yen immediately, and give it to you. And then it will do a back-to-back trade on the other side. So it will not be carrying that risk throughout on its book. So there are very few gaps gaps in that kind of scenario for foreign exchange, because that risk is managed dynamically at that point in time. And most of the time it's very short term, it's not long term. So that is something that banks will usually manage immediately without keeping too much of a gap. So I don't think that is a huge issue where it comes to tenor. So going on to currency. So basically, if you look at currencies, again, there are various positions. So for example, what we have been talking about in currencies exchange, where you exchange rupees into dollars or whatever it is to manage your foreign exchange risk. But there is also a risk in terms of what we call funding requirements. So maybe there is no foreign exchange, there is no conversion of dollars into rupees, but there could be a requirement where an importer or an exporter has dollars and he has a dollar payment to make against a dollar receivable. The bank has to make sure that they have sufficient funding in their dollar book to meet this requirement. So let me explain this to you. You say you are say we are a garment exporter. You have dollar receivables, which will come into your dollar accounts. You're going to use those dollars to make payments for your machinery, which you are bringing down from the US, for which you will pay US dollars. So first tell me, is there a foreign exchange requirement there?
Yes.
So you're a garment exporter, you will receive dollars into your dollar account. You need to also, the same garment export needs to bring down machinery for its factory, which is in US dollars, from a US dollars person selling it. But he will use the dollars he gets from the garment, his garment sales, to pay for the machinery. Is there a foreign exchange risk there?
No.
No.
There will not be a foreign exchange risk. But now the bank has got a deposit in dollars and the bank has a payment to make in dollars also. So how does the bank have to manage that? So the bank basically has to manage to make sure that it has enough dollars in its what we call nostro account, in its dollar accounts, so that when the client says, please pay this amount of dollars to my machinery supplier on this day, that we have enough dollars in our dollar book in New York to pay for that export, because our client has requested us to do so. And we can't wait for the dollar client to get those dollars from another. He could already have those dollars from his export receivables. He could be receiving it. But the bank itself has to make sure that it has the liquidity in its dollar account in the US to make the payment to his supplier in the US. So in other words, the bank has to make sure that it has the required currencies in the required amounts in their respective countries and that those currencies are in order to make the payments for their clients. So they need to make sure that they manage their funds in those accounts in an efficient way based on client requirements. And if they don't have funds in their dollar account at that particular time, they have to be able to go out and borrow funds from other interbank counterparties to meet those funding requirements of banks, of their clients. Right? Under that, I'm on slide 27. Under that, the second point, the next exchange position equals the present value of all assets spot and forward. That is talking about foreign exchange, where there have been exchange traded, exchange transactions. So I won't go into that. But for the moment, I just want you to understand that fund management in this case is basically where, even if there is no foreign exchange requirement, that the bank has to be able to manage its currency requirements for banks, for their clients on an ongoing basis based on the payments and receivables from their clients. Okay, so we have touched on, just to go back, what variables fund managers should look at: amount, tenor, currency they are using, and the risk. Now we are going to the risk. Now, looking at all these things, looking at the tenor, the amount, and the currency, and all that, the fund manager now needs to figure out, by me taking this deposit or making this payment, what are the risks that I'm going to take? And there you have broadly, there are more risks, but there are 3 risks that we are talking about here at this point. But there are other risks as well, which I'll talk briefly. But for the moment, 3 risks: liquidity risk, credit risk, and market risk. What is liquidity risk? We've discussed this at length now, so I'm sure you are clear about it. Liquidity meaning, by me lending this money or by giving this money out for a longer tenor, does it mean that I will have a liquidity issue on my own books? So, for example, if somebody comes and tells a fund manager, okay, I have an instrument, 10-year instrument in Sri Lankan rupee bonds. It's going at 15% interest rate. Fund manager looks at, wow, good interest rate. Fantastic. I don't mind doing this. I can put it on a 10-year deposit and I can basically fund it on overnight money market rates. Fantastic. I can make money on this. And it's good for the bank and everything. What is the risk? Does he run a liquidity risk there? Does he run a liquidity risk?
Can you repeat it, sir?
Okay, so you're a fund manager. Somebody comes and tells you, I have a 10-year instrument, 10-year treasury bill or whatever it is, a 10-year treasury bond. I'm giving you 15% interest rate if you buy that bond. And now the fund manager needs to decide, am I going to buy this bond, a 10-year bond or not? Does he have a liquidity risk if he buys that bond?
Yes.
Yes. Why does he have a liquidity risk?
Because since this is a 10-year bond, you won't be able to sell it in the secondary market if you have a requirement.
Very good. It can be so, but it'll be very difficult. Let me put it that way.
Yes.
Okay. It's not as easy as selling a 1 or 2 year bond or whatever. Yes, there was somebody else saying something as well.
Yeah, there's a maturity mismatch. He's using short-term funds to long-term investment.
Yes, correct. There is a maturity mismatch there as well, and which basically can result in when, like we discussed earlier, if interest rates go up, fine, there's a risk there in terms of the profitability, but there's also a point that you might not be able to raise money in the money market for your liquidity, short-term liquidity requirements if you need it. So there is a liquidity risk there. So does that mean that this fund manager won't do this necessarily? You think he'll say no to it immediately?
No, he will buy it.
Yeah, so what he will look at it, if I were him, I will look at it from a portfolio perspective. I will look to see, okay, how much of other bonds do I have in the same maturity bucket? How much of funds available do I have to support my short-term liquidity requirements? Can I afford to buy this bond and put it in my book if I have only, say, 10%, or it represents only 10% or 5% or 10% of my portfolio? Is the risk worth taking for me for that return? So if I were a fund manager, I would look at it more from a portfolio perspective in terms of my liquidity, so that it's not just taken on that instrument itself, from a liquidity perspective. Yeah. Okay. So the second risk is credit risk. So what is credit risk? What is credit risk? All of you are working in banks, or most of you, I think. You all should know this very well.
the ability of the issuer to honor the contract?
The ability of the issuer to honor the contract. So in other words, what we're talking about is when a bank lends to somebody, it's always taking the risk that it will not get that money back. The bank manages that risk by either getting collateral for that risk or by doing an assessment on the person's income, and basically looking at him and saying, okay, we can give you X amount of money that is secured, X amount of money that is unsecured. So going back to my example, if this person had bought a 10-year bond, Treasury bill, which is government of Sri Lanka, for example, what kind of credit risk is he taking there? Government of Sri Lanka Treasury bills. What kind of credit risk is he taking? All of you have money in your pocket, right? If you have a note in your pocket, you can see it's issued by the Central Bank of Sri Lanka, right? So a treasury bill is as good as that. It's basically a promissory note from the government that basically if you give us money, we will pay it back for you. It's endorsed. So it's the highest credit rating from a domestic perspective. It is the highest credit rating. Same as in the US Treasury bills, or in the UK Treasury bills, bonds, gilts are the highest rated instruments in that particular market. The most highest rated bonds in the world come from US, from Japan, from countries like that, which are like AAA, AA rated instruments from a credit rating perspective. So, but credit risk is basically an assessment of the risk that is there when you buy an instrument. Now, if you, in this case, if it's a treasury bond, you are buying something that the perceived risk is very less because it is issued by the government entity. So maybe on that you say, yes, okay, it's a good risk to buy. Then you have market risk. Market risk is what we discussed earlier, where basically the interest rate moving higher. If you are going to fund this on a short-term basis, if the market interest rates move from 6% to 12% and you have bought an instrument that is 10, that is market risk. So you need to make an assessment of what is the market risk I have in buying a long-term instrument like this. Should I go out and pay for 10 years and borrow money for 10 years, or should I do short-term? Or should I just stay away from this because I don't know what the market risk is, or I can't make a clean judgment? So market risk is the risk of the value of that particular asset or the instruments you're using to hedge that asset moving around or changing due to market factors. So interest rates going up and down, foreign exchange rates going up and down, commodity rates going down, etc. Is that clear?
Yes.
Okay, so liquidity risk. So like we discussed.
Excuse me, sir.
Yes, please go ahead.
Can you please explain the market risk again?
Sure. Thank you for asking the question. So market risk is, for example, if you have bought a treasury bill at 10%, yeah, and if you are now going to, and you have not raised the money, you have lent your money for that, now you have to go and fund that treasury bill. So you have to find ways of borrowing money because you are doing it as a out of your deposits. You have paid, say, you have bought a treasury bill for 10 years at 10%, and you have raised 1-year deposits at 6% for that. Yeah. So now you're okay. First year, you're all right because you got 6% against 10%. You're clear about that, right?
Yeah, sir.
Okay. So now, for example, in 1 year's time, suddenly interest rates have gone to 12%. Not because of anything the bank has done, just the market interest rates have gone up. because of monetary policy, the condition of the economy, whatever you want to call it, the interest rates have gone up to 12%. Now you still have a treasury bill that is 10% on your books. Next year you have to pay 12% for your deposit. Are you now positive or negative for that year?
Negative.
Negative by 2%. Now what's the reason for that?
Because I have to pay 12% for deposits now.
That's correct. And the deposit you have to pay 12%. Why? Because the market interest rates have gone up, right?
Yeah.
Which basically means the market risk you have taken at the time of doing this has gone against you. So you've taken a risk, it has not worked for you. However, if you have done it at, if we'll go back to the example, if you have bought at 10, you fund first year at 6%, second year rates have gone to 4%. Now it is positive for you, even more. Or it remains at 6, still you're fine. Or instead of going for 1 year deposit, you manage to get another 10-year deposit from somebody at 8%. Then you're perfectly hedged. You have 10% against 8%, you have no market risk. So the market risk, how you manage it, how you would decide whether you go borrow 1 year money or 5 year money or whatever, will depend on your own assessment and judgment and knowledge of the market. Sometimes it can be right, sometimes it can go wrong. So that's why it's called a risk.
Okay, so thank you.
So the liquidity risk, I've touched on it already. I'll just go through it. Bank will be unable to liquidate their assets to meet financial obligations. We already covered that. Exposure to liquidity risk occurs whenever the maturity of assets are longer than the maturity of the liability. So which exactly what I was talking about, the deposit and the lending part of it. Yeah. Credit risk, the chances the borrower will be unable to repay the principal or pay the interest. In foreign exchange, the possibility that one party will be unable to fulfill the contract to exchange currency for that. So, for example, you entered into forward contracts, and you are supposed to, the guy is supposed to give you rupees, and you are supposed to give him dollars. He can't say, he says he doesn't want to give you the rupees. You have a risk there that you have to go and sell those dollars in the market at whatever the rate to fulfill those obligations. So there's a credit risk there. Market risk is basically what we just discussed. Charge of interest rates or exchange rate movements will adversely affect the value of the assets and the liabilities. So in other words, if you have bought one of the things that I told you is what I just mentioned is the market risk in terms of liquidity and funding. There's also a chance where, in addition to that, I should speak about that also. If you have bought a treasury bill for 10%, and even if you're okay with funding it, if the treasury bill, 10-year treasury bills now go to 12% or 13%, you bought it at 10, and then you suddenly need to liquidate that treasury bill or bond because you need the money. If you bought something for 10% and then you need to sell it in the market and somebody is asking for 12%, are you going to lose money on that or not? You have bought something for 10, but you are going to sell it now, and the person who is buying it from you is basically saying, look, if I'm buying it from you, you have to pay me 12%. I'm getting 10% from somebody, but the other person is asking 12% from me. Do I lose money on it or not?
Not.
You will lose because that guy is asking for a higher rate and you're getting paid. So you're going to lose money. So market risk, not only from a liquidity management perspective, you also have market risk if you have to get rid of that asset. Where if you say for whatever reason you need to get rid of it and the price of that asset has changed against you, then you will have to unwind it at a loss. And then that risk is also something that you have to think about if you need your when you are looking at a funding situation.
So that meaning is once the interest rate goes up, the price of the underlying asset come down. Is it?
Goes down. Correct. That's right. If you have, it's an inverse relationship. Prices go up,
Yes.
yields go down. Yields go up, prices go down.
Right. Right.
So basically, three types of risk: liquidity, market, and credit. For this purpose, there are more risks, but for this purpose, those three. So what does Treasury do? Again, we are going back to where we started. Banks, liquidity, making sure that the gapping position in terms of tenors, like we discussed, are managed. Net exchange position is managed and looks at where we are exposed to this risk and manages that. And they do that by looking at the amounts, tenors, currencies, and the type of risk that we need to manage. So again, if you look at slide 33, you have assets, amounts, tenors. It basically is talking about the same thing. It's just going into a bit of graphs there. Again, we're talking about liquidity and the ability to meet financial obligations of the bank without delay. It is also a measure of the bank's liability to fund any asset it wants to acquire. Is that clear?
Yes, sir.
So just going into a bit of more liquidity. Basically, as you know, the bank needs liquidity to cover all its obligations. So if we don't, and depositors find that they are not getting their money back when they walk into a bank, that basically creates a very knock-on effect, effect that it has a domino effect on the whole bank. So if I walk in today and if a bank says, look, we can't pay your money to you because we don't have that money in the bank today, I might say, okay, fine. If it's a large amount, I might understand and comes, okay, I'll get it ready, I'll come tomorrow. But you go tomorrow again, and the guy says, look, sorry, I don't have the money, it may come again tomorrow. I'm going to get worried that this is a problem. This guy doesn't have the money to give me. Yeah. And then if that news goes around with, hundreds of depositors, automatically there's going to be an issue and there's going to be a concern that there is a liquidity issue in that bank. And people are going to queue up. That has happened in the past, Northern Rock in this picture and a lot of places like that. Soon as people found, and so sometimes even if the bank doesn't have a liquidity problem and it's just a matter of maybe where they had a shortfall for a short time, this mere perception that there is can have a run on the bank, as they call it. And where depositors queue up to basically come and take money out of the bank because they're worried that, look, I have a problem. There's a problem with this bank. I need to take my money out of this bank. So why would a depositor put money in the bank? Because yes, he wants a higher interest rate for sure, but it is also he'll pick a bank that gives him the best services. But I would think one of the most important things you and I would look for when we are putting money in the bank, outside of the interest rate and the fees and the benefits and all this other stuff, is that, look, I want my money back. And if I don't get my money back, I'm not going to put that money in the bank. So if you have been following the last 3 months, what has been happening in financial markets, you have seen the stock markets have been extremely volatile, gone down, gone up. Now, banks have basically, there's been a flight to quality, as they call it, where people have been moving money into secure assets, like we spoke about just now, into US Treasury bills and things like that. Why is that? They have been doing that because they want their money in a safe place, in uncertain times especially. So in normal times also, but especially in uncertain times, people don't want to put their money in a place where they don't think they'll get it back. If they are taking a risk in the terms of the, if somebody is taking a risk and putting their money in a place that they are not very sure about the quality of the bank or the institution, what will they demand for? I'm asking the question. If somebody is putting my money in an institution that they feel they are not 100% sure about the bank, that particular institution's repayment to them again, but they are willing to take the risk and put their money there. What will they demand for them?
They could demand for higher interest rate.
That's right. Correct. So if you are an investor, if you are a depositor and you go to an investment, somebody is offering you 15% interest rate and another guy is offering you 5%. What's the first thing that comes into your head? If you are a smart investor, the first thing that you will ask is, why is this guy giving me 15% as why when the normal rates from other people are 5%? Because the 10% differential is representing his inability to borrow money cheap in the market and raise liquidity cheap. So he is willing to pay a premium to raise the liquidity. Now, does that necessarily mean it's a bad thing? Not all the time, but it could. You have to be extra vigilant. You have to take extra care. If you do not take extra care, you are and you don't, look at the risk you're taking, there is more chance of you losing money on the person paying 15% as opposed to the person who's paying you 5%. So you have to be mindful of that and take that into account. We've had institutions like this, instance like this in Sri Lanka as well. If you look at like the Golden Key and people like that in the past, where they paid like 30% interest and whatever at that time, and banks were paying 15-20%. So but depositors were happy because it was something that was going on. It was a well-established company, all that. But interest rates usually represent the bank's ability to borrow from all end from their clients, and their ability to access funding, access liquidity. That's the main thing. And if it's in par with the market, it shows it's going with the market. If it's a way off the market, it represents the credit risk and what they're willing to pay as a premium for that credit risk. Is that clear?
Yes, sir.
Okay. Yeah, so slide 37, I think what it says there is very clear. Banks can lose money. There's no problem. You can buy that treasury bill for 10%, interest rates can go to 20%, and you can lose money because you've done a wrong deal. Or you can buy foreign exchange at 185 rupees, and then the rate can go to 175 rupees, and you can lose money. That's all part of the bank's ability to manage its risk, and banks lose money. I have personally lost money on some of my transactions. The bank as a whole where I work for, there are days we lose a lot of money, but overall it still has to make a profit. That's a judgment that you make as sitting in that, the position that you take. But the bank cannot afford to be illiquid. In other words, even if we lose money, it's fine. We have to maintain our liquidity to service our requirements of our clients. That is not an option. We have to be liquid. We cannot be liquid. If a bank becomes illiquid, like we said, can't pay the depositors, they can't pay the obligations, it will affect the liquidity of other banks because you are working in an interbank market where everybody is depending on each other, and depending on how systemically important you are to this financial sector, it can have an impact on the whole financial system of an organization. So, for example, if you all are familiar with the global financial crisis of 2008 and 9, the cause of the global financial crisis was the Lehman Brothers collapse, which was a big bank in the US. And when they were not supported by the US government and they said, look, it's your problem, the whole thing had a knock-on effect on the whole all the market participants there. And people lost confidence in the financial markets. And that resulted in the financial crisis, which took almost 7-8 years or more for people to come out of. So liquidity is critical for bank administrators, for shareholders, from the regulator, to customers, to everybody. It is very important for the bank to make sure it has its liquidity ratios, and it basically you judge that by looking at your financials and seeing what your ratios are like, and the bank has to manage that.
One question, sir.
Yeah.
Just want to know, like, say now, Treasury Department is to manage the funds. I have heard that in the morning, Treasury people seek how much of money they want for the day to their fund management. How are you going to how are you going to find out it? The practical aspect of like what is the practice of identifying days fund position, the required days, today's fund position, the requirement, practically how Treasury looks at how what are the methods used to identify
Sure. So what happens is that you have say the day's requirements. You have opening balance from the, as you know, each bank has an account with central bank, and you will get the closing balance from the previous day and the opening balance the next day from your systems. So this is the balance that you have. Then you have the known debits and credits for the day. So for example, foreign exchange, you have bought and sold, deposits that are maturing on that day, loans that will be repaid that day. You have those already in your systems because you know that, right? You can see that with your systems. You'll have that. So those ins and outs against the balance you have a rough judgment. Okay, this is the surplus I have, this is the deficit I have, right? That's clear, right? That is very obviously there. In the morning when you come into work, you should have that information on your computer. Then during the day, there are payments in and out to your account, nothing to do with those maturities. It could be just trade transactions, payments that need to be made by clients, whatever. Those forecasts of payments are given by, some of it is given by the teams when the client calls it, I need to transfer this much of money out, whatever. All those are updated into the system. So then you have a knowledge on that day of this much of money during the course of the day I will need to borrow because of these requirements falling due on that day, not maturities, but transactions coming on that particular day. So customers will call and say this. So you have put down certain cutoff times. Say clients need to inform their daily transactions by 12 o'clock, 1 o'clock, whatever the cutoff time is. So they need to give all those requirements before that. So at that particular time, we'll say 12 o'clock is the cutoff time. You will have the bought forward balances with all the net in and outs and all that. Then you will have your daily balances all put in there. Okay, 12 o'clock, this is the amount of money I have surplus, or this is the amount of money I have to borrow. Then based on that, I will go and say, okay, do I borrow this from the central bank reverse repo? Do I go to the money market and borrow this? Or do I basically go and sell foreign exchange or something like that to manage this rupee requirement or whatever it is? And then you go out and manage it. Now, that is on a day-to-day basis. Then you also make projections for the week, 2 weeks, for managing the reserve and all that for 1 month, and even go as more as 3 months, 6 months, even up to a year. Those are long-term projections. So what do you do there? Obviously, you don't know the daily transactions that are going to come through on a daily basis, but you have a rough estimate of, based on going back and doing sort of a back testing, that you have daily payments of about 100 million rupees or whatever amount that you have on a day-to-day basis. You use that as a core, and then you use the the balances that you need to make, whatever, and you make projections based on your known cash flows and unknown cash flows. You made estimates, and you will project, okay, this is my liquidity requirements for the next month, next week, next month, next 2 months, next 3 months. And based on that, they will decide, okay, there are these big maturities coming up in the next month. There are some deposits that are maturing in 3 months' time. Will this client renew that deposit with us? Check with the department, talk to your client. Can you tell me whether he's going to renew this deposit or not? If he's not going to renew the deposit, then you need to make alternative arrangements for that. Yeah. And based on that, you will decide, okay, then if this guy is definitely not going to make this, I will need to then pay a little bit more and borrow from somebody else so that we plug in that gap. For the long term, it's very much an estimation that you make based on your known cash flows and your unknown estimates, basically. But for the day-to-day one, you can do it with a quite a lot of accuracy, because you know the transactions that will go to. You have cut-off times, and as long as you go into the market, be able to go into the market and do that. What happens sometimes is, if there are errors, if a client says I'm transferring 1 million and transfers 1 billion, then you have a problem. Then you have to go and rectify these issues, and that can happen. And those are what we call, we didn't discuss this risk, but those are what we call operational risks that lead to liquidity issues. Those are because of errors. And then, or if the client tells they're doing something and then there's something else. So those risks are there as well, which you need to manage, and practically those happen. But normally this is the way it would be looked at. Does that answer your question?
Yes, yes.
Okay,
Thank you,
so
sir.
no problem. So we'll go into the next section, which is basically the role of central bank. Any questions other than that? Okay, so basically central bank, there are many roles, but in this particular thing, we are looking at a few functions. Basically, it's not they provide liquidity for banks and as and when required. And basically, they are, like I mentioned earlier, as one of the functions is to use the banks, and central bank and the banks are one of the key players in managing money supply. So money supply, if you all have done any sort of banking course in the past, you know, is, or any other thing with money, is money held by the public in terms of currency notes, in terms of demand deposits, time deposits, current accounts, in commercial banks. So how money supply happens? Central bank will issue, say, 100 units or 100 whatever. The bank will take 100, and because of what we call a statutory reserve requirement, SRR, where central bank will say, look, you can't lend a deposit. If you get a deposit of 100 from your client, you can't lend all 100. You will basically have to lend only 90, because we want you to make sure you have 10 from a risk perspective, from a reserve perspective, from a capital perspective. You need to keep back 10 of that, and you can only lend 90, thereby making sure that there is a certain amount retained by the bank for leverage, where the bank can't leverage 100% on the deposit that he takes. So he'll take 100. If the SRR is, say, like I said, 10%, he'll lend out 90. And then the guy who borrows the 90, assume he goes to another bank, deposits that 90. The bank will be able to lend another 81 from that 90. So it goes on and on and on and on and on. So basically, in this particular example, the 100 that was deposited has been moved around twice, 1 to 90, 1 to 81. And in the process, the 100 units basically has created loans of up to 171. So 100 deposited, gave a 90 loan first, and then 90 loan gave another 81. So in other words, with a 100 deposit, we have created loans of up to 171. So what it means is that money supply doesn't necessarily increase with a simple 100 deposit for a 100 loan. Money supply increases many-fold because of the way the money moves from bank to bank, from institution. So it is a leverage fund, the amount that moves around, not a one-to-one move in terms of the creation of loans and liabilities for individuals. Is that clear? You all have done this before, I presume.
Okay, sir. Okay.
Right. So, like I said, the role of the central bank is to manage, one of the roles of central bank is to manage this money supply, to make sure that the currency in circulation and the deposits in circulations are basically in line with the values that, or the amounts that they perceive to be sufficient for the economy. This is the slide 43 is basically from a table from the Central Bank of Sri Lanka annual report, which basically provides you with a brief outline of the currencies outstanding. This is 2016 to 2017, and the changes in each of those components we spoke about: currencies, commercial bank deposits, government agents deposits, all the things that fall into what we call the reserve money and money supply, narrow money supply, broad money supply, which is what we just discussed, with time deposit savings and all that put into it. As you can see, in 2016, it was 4.8 billion. It has moved to 5.6 billion. In other words, there has been more money created over a year. This could be by currency notes being created. This could be by, so if you can see, currency notes created has been 40. Yeah. And if you can see where the increase has happened, has been mainly with commercial bank deposits with central bank. So if you look at all that without going into too much of details, you can see that there has been an 18% increase in money supply. Now, what is a good level for the increase in money supply is always a debatable thing. But it is something that will be there depending on the economic situation of the country. So currently, there is an increase in money supply because there is a need to stimulate the economy. With the need to stimulate the economy, you have to have more money in the systems. That is what even the US is doing right now. If you looked at the news, they have brought their interest rates down, and they are also buying back treasury bonds from the market. In other words, they're putting more money into the hands of people. So which basically means there will be more money in circulation. That's what they did after the global financial crisis, and that is what they're doing now as well. So the next slide, the role of central bank. Basically, we're leading up from this whole money supply business to the broad economic role of a central bank. Before that, I will stop there. Is there any question, please?
This is not relevant to this thing, but I just want to know what are the front office systems right now available in Sri Lanka as well as world, like
Front office systems for what, basically?
basically in the sense that I heard that Treasury use the separate system. The name of such systems, like maybe.
Okay. So basically, from my experience with thing, if different banks use different systems, we at HSBC, for example, we have our own built systems for different assets. So foreign exchange, we have one system. We have a home inbuilt system that we use. And in other banks, local banks, I think they have various systems that they have bought from different providers. So there is no one system. There are systems called what they call Murex, and for information purposes, people use terms like FXall, or for information purposes or trading purposes. But for, if you are looking at it from a trading platform perspective, the two common systems are Reuters and Bloomberg. Those are not deal booking systems, but those are mainly for your ability to trade. So if you have a Bloomberg system, you can converse with people and you can do a trade with somebody. If you have a Reuters system, there are Reuters messaging and Reuters dealing systems, which you can use to talk to people and book and conclude a deal. But after you conclude a deal, if you say buy or sell something, you have to also put it into a risk management system. The risk management system that banks use can change from bank to bank. It could be an in-house built system. It could be something they bought from a third-party provider. But the common platform for people to trade with one another would be Reuters or Bloomberg. Those are the two most common things that people use.
Okay, thank you.
Right. So I'll go on to the role of central bank. So you all must be aware of this. So basically, money supply, that's fine. And when they look at money supply, central banks, and will look at the impact on inflation. Increase money, will it increase inflation? Increase inflation, do we need to increase or decrease money based on where we are in the economic growth cycle? What is the impact on the balance of payments? In other words, will an increase in money supply lead to a depreciation in the rupee and therefore a balance of payments crisis? And then, like I said, exchange rates and interest rates. What is the impact of money supply on exchange and interest? Will it lead to a depreciation of the rupee? Will it lead to an increase in interest rates or a decrease in interest rates? So money supply has a direct impact on all that. But it all depends. It's not necessarily that it's a wrong thing. It is about how much and at what point in time you need to manage it. So to control money supply, they use 2 or 3 main instruments. One is the SRR. Basically, you borrow 100 from a person, you can only lend out 90 if your SRR is 10%. That way, you prevent X amount of money going into the system. The bank rate, so basically the rate at which the bank would basically lend at two commercial banks. There are different bank rates. This is referring to the lender of last resort, but there are also repo, reverse repo rates as well. And what we call open market operations, basically where they would buy and sell treasury bills to manage the money supply in the market. Is that clear? We'll go into detail in the next few slides, but if not, let me know. So the SRR is the amount of cash or the liquid asset normally expressed as a percentage of demand and time. So basically what I said, you borrow 100 from a depositor, you can only lend 90 of that from a bank. So the commercial banks are always governed by the SRR. If the bank wants to increase the money supply in the market, what would the central bank do? If they want to increase money supply in the market, what would they do? Assuming the SRR today is 10%, and central bank tomorrow decides they want to increase money supply, they want more money in circulation, what would they do?
They'll reduce the SRR.
Exactly right. They'll reduce the SRR, so that basically there's more money out there for banks. And reverse if they want to reduce it as well, reduce the money supply. Okay, so this is the bank rate. So with the bank rate, you're referring to the rate at which the banks can borrow funds from central bank as a lender of last resort, where the banks have no other option. They have sold their treasury bills, they can't get money from their depositors, but the central bank is the lender and say, look, I need money, central bank, please help me. So the bank rate will be the final rate. Most banks don't want to go there not because central bank won't give you the money, but it would be seen as a very banks should go there if they have a liquidity requirement because they have to do right by their depositors. But it's a lack of confidence that the market will have in them if they have to go to central bank and borrow at the bank rate. It shows that their credibility and their credit quality has deteriorated significantly, and they are in the large stages of bankruptcy or something like that. So it is there as a liquidity measure. If it is taken as a result where the market is depressed, where the entire market is basically unable to borrow and there are no lenders in the market for whatever reason, then it's fine. But if you're the only one going there in a bad market condition, it shows that your quality has dropped and it's not an extremely good place to be. But it is available for your liquidity requirements. And then the most common thing that is used on a day-to-day basis is open market operations. So basically, we'll go back to the example of determining your cash flows. At 12 o'clock, I have realized, oh, I have ₹1 billion sitting in my account that I need to invest. I don't have anybody to borrow it, no customers to borrow it. What do I do? If I keep it in my central bank account, I get 0 interest rate. Yeah. So I go and ask, there's a repo window, 6% again, whatever the rate is. I say, look, I want to lend money. Central bank, sure. Central bank has a stock of treasury bills against which they will borrow the money and lend it back to you the next day with the 6% or whatever interest rate. So that's the central bank's what we call repurchase window. It's called shortened form repo. Those deposits taken by central bank are backed by the stock of central banks, treasury bills and bonds that they have. Same way, if you're short of $1 billion and you have treasury bills in your portfolio, you can pledge those treasury bills to central bank and say, I want to borrow. You go to their reverse repo window and say, okay, they say, okay, I'll lend you at 7%, reverse repo. And you borrow from them back at 7%. And these auctions usually happen daily. And then there are standing facilities, basically where you can go and access funds, not against repos, but against central bank securities or whatever it is. And the other one is FX swaps, where you can go into what you call a foreign exchange swap market and swap your dollars into rupees or rupees into dollars with another interbank counterparty or with the central bank to meet your dollar requirements or your swap or your rupee requirements. That's very popular and done quite a bit amongst the interbank counterparties. So you might have excess rupees, but you don't have dollars. So you might go to the market and say, okay, here, I'm giving you my rupees. Give me some dollars for a month. The bank will say, okay, fine, I'll buy your dollars at this rate. I'll sell you the dollars back at this rate or whatever it is. And in between, they'll charge you a rate for you to borrow dollars from them. So this swap market is used for generating liquidity in foreign exchange, through foreign exchange in rupees as well as dollars. So that is temporary. These are very short term. Permanent basis will be where you would go out and say, look, I need money, open market operations. You go out and say, I need money. I'm going to sell my treasury bills. You just go out and sell your treasury bills and raise liquidity. Or you have excess money. You decide, I'm going to go to the secondary market and I'm going to buy treasury bills. You just go and buy outright purchase. That's it. It's a simple transaction, but that's more permanent. That's to say, look, I have a view on interest rates. I have a long-term liquidity requirement which I need to I need to manage. So I'm just going to go and do this. I don't want to go to the repo market and do temporary fixes. It has to be a permanent fix for me. Is that clear?
Yes.
Yeah.
Okay, so right, so this is just a reflection of the deposit rates, slide number 5050, and the standing rate corridor and the AWCMR, average weighted call money rate. So the call money rates where you would go and borrow and for short-term requirements, and what the standard rate is, and what the special deposit. So it's just a reflection of the market rates over the years, as you can see where our rates were. So right, so now onwards for the next few slides, we actually go into some questions. So I'll take you through them. The bank concentrates on two major operations which create a natural organization structure. What are they? Any volunteers? What are the two main structures, going back to the beginning of the presentation or the session? What does a bank do?
Taking money in, loaning money out.
That's right. Correct. Very basic. Yes, that's right. Question number 2. Liquidity versus illiquidity depends on whether you have mismatched amounts of each currency, interest rates, assets and liability, net exchange position. How is it determined? Whether you are
Assets,
liquid or not.
assets and liability.
Correct. So it's not necessarily to do with interest rates. It's mainly how much of liquid assets you have against your on-demand liabilities, basically. The present value of each currency on the asset side minus the present value of each currency on the liability side is calculated to derive the bank's what? So this is to do with foreign exchange. So if you present value all the currencies you have on the asset side, what are you trying to get at here? Because you're talking about currency exchange here. So what are you trying to get at here? You're actually looking for the next exchange position. So you're looking at taking all your buys in, say, dollars and your buys in, say, rupees and coming up and saying, okay, this is my net exchange position for the bank. The period between the maturity date on funds that have been borrowed and the maturity date of funds that have been placed is called what? Easy one.
Gap.
Yes, correct. Gap. The microeconomic significance of liquidity management is the remember the word, it's microeconomic significance of liquidity is the what? Bank's ability to meet its obligations on time, loan department's ability to make loans, stability of the country's banking system, stability of the world economy. The microeconomic significance of liquidity management is what? Easy one. Why would somebody manage liquidity in a bank? Think small, not big.
Bank's ability to make
That's
Number
right.
A.
Number A, yeah, basically A, correct. Macro, same question, macro. Why would it be important of that, for that?
Also would be D.
Sorry?
D. Stability of world economy.
I didn't hear you, sorry. Did you say C or?
D. Last one?
No, C, I would say C because, see, yes, okay. So that's a bit of a, you can argue, can it be D if you're calling me from, say, the US or something like that? And if it's a bank like Goldman Sachs or what happened with Lehman Brothers. What happened with Lehman Brothers in 2009 had an impact on the US economy and the world economy. But that is very rare if it happens in, say, Sri Lanka. All this time we've had issues in the US also, but we have not really seen any problem with the Sri Lankan economy as such as a result of that. So I think in this case, you have an impact on the stability of the country's banking system by watching your liquidity in that particular country. Very rarely, not that it won't, but very rarely, and it all depends on the world economy. It will have to be a very significant player in the world economy who has had an impact, and then that can have an. But I don't think we're at that stage. Like I said, global financial crisis was the last time that's something like that, but that's a black swan event, and that's a rare event, not necessarily a normal situation. Central Bank of Sri Lanka, Central Bank of each country usually mandates that a certain percentage of each bank's commercial deposits be retained as liquid assets. This is called what?
SRR.
Yep, good. B. Easy. The instrument used to control borrowing by commercial banks from the central bank is The instrument used to control borrowing by commercial banks on the central bank is, again, this discount rate. So basically, this is the rate we're talking about, the bank rate, or open market operations in this case is the discount rate. Basically, the banks can borrow from central bank at the discount rate. Yeah. I'll go into the other presentation as well, and we can actually look to finish that as well. That will not be too long, but just to summarize this one, if you look back where we started off in, main objectives of this particular, give me a second please. Particular is recognize the role of Treasury within the bank. We did that. We understood what a Treasury does. We understood what the functions of a Treasury was, and that it was a separate function by itself, and it determines the bank's mix of assets, liabilities, and manages the bank's risk, and has a trading and sales function as well. We identified key factors in fund management, how the fund managers have to look at tenor, amount, values, etc., and the risk involved when they decide on how they manage these funds, what kind of instruments they use, etc. We defined liquidity, and we looked at what liquidity means, how important it is to the bank from a short-term perspective, from a long-term perspective, and why liquidity is important, more important than making money, because of the confidence of because of a lack of liquidity leads to a lack of confidence in the bank and the banking sector. And then finally, we looked at the central bank, the role the central bank plays in terms of money supply to the economy, and then also the role of central bank in terms of managing the money supply, what instruments they use in terms of SRRs, bank rates, open market operations, etc. Yeah. Any questions, please? Please do ask. We have some time. We have another hour, which I will use to go through the other slide on reserve management, which will not take too long. But I just want to know before we go on, any other questions, please, on these slides or anything else?
So,
Yes.
what's the difference between the bank rate and the standing deposit facility?
Standing deposit rate is basically, the bank rate is the rate at which the bank can borrow from central bank at. Standing deposit rate is the rate at which the central bank will borrow from you at outside of the repo reverse repo.
Okay, thanks.
Also, I just want to touch on something on the risk. We touched on 3 types of risk: liquidity risk, credit risk, and market risk. There are other risks as well that you all should know about, and I'm sure you all know about it. When I say it, you all will know, but it's not touched here. There's what we call reputational risk. If you do a transaction with a client, or if you do a transaction with somebody and you don't honor or the client doesn't honor it, or you don't honor it, or you get into a client who has done an illegal activity, you run the risk that your institution also has a reputational impact. That's what we call reputational risk. Then in this modern world, like I mentioned earlier, you also have financial crime risk, where basically you will have a situation where a client who has got money from, we'll say, illegal activity, we say drugs or something like that. He uses the bank to funnel that money. That risk is also there. That is called financial crime risk separately. Then we have another risk called operational risk. Operational risk is where, what I mentioned, where if you're, say, projecting your cash flows, or you're putting in a deal. A junior dealer is putting in a transaction into system. Instead of 1 million, he presses 1 billion, or instead of 1,000, he presses 1 million, something like that. And the bank actually processes transaction. The bank's controls don't catch that error, and then you end up with a loss, operational loss. That's operational risk. So there are many other risks involved. But the Treasury will look at these main thing, mainly the market risk aspect of it, and some bit of the credit risk aspect of it, and basically liquidity risk on the other side. So, but there are a lot more risks, and these risks have actually increased over the years. In the past, banks mainly looked at credit risk and liquidity risk and credit risk, liquidity risk, and market risk. But now, the amount of risk that the bank look at when they get into a transaction with a client, with the interbank, is much more than it used to be, especially over the last 10, 15 years. Okay, I will step into the other presentation now. Hold on a second. Right. Like I said, this is not a very long presentation, and it covers mainly on reserves. Mainly the function of more to do with, some of it is related to the bank's own requirements, and other one is to do with the requirements coming in from the regulator. So there are reserves that are operational reserves and legal reserves. So reserves meaning the amount of money that you have to set aside, like we have the SRRs and so on. How much money do you have to put aside separately for meeting? One is your operational requirements, that is your daily, day-to-day requirements. And secondly, the other one is to meet your legal requirements, basically what you're obligated to meet. Yeah, like I said, operational reserves would be determined by a bank based on its own needs. Legal requirements are imposed by the bank to the bank by central bank. It could be also other regulators, but mainly by the central banks of that particular country. So basically, operational reserve, cash and other liquid assets kept by the bank to cover possible liquidity needs. We've discussed this already in detail, but basically what it talked about is, look, if there is a requirement that my depositors want their money back, what are the reserves I have put aside separately to meet those requirements? As we know, to answer the second question here, a bank cannot lend 100% of the money from deposits to loan to customers. They have to keep a certain component of that with them. But at the same time, when they do lend money out, they have to make sure that they lend it into assets that are liquid and that they can liquidate and give their clients to. So, going a little deeper into that, banks require funds for? What do the banks require money for? Financial payments. So, you remember when we discussed, and there was a question about how the banks will project their liquidity requirements and their cash flow requirements over the next 1 month, 2 months, 3 months. How do they project it? One of the ways, like I said, was what are the time deposits that are coming due in the next 1 month, 2 months, 3 months? What are the big deposits that are coming due? What are the clients going to do about that? Are they keeping it with us? Are they taking it out? What are the demand deposits? Basically, demand deposits are basically, say, current accounts or savings accounts, basically, savings accounts, which the money can go out at any time. You don't have to, the client doesn't have to tell us. He comes today, puts 1 million, takes out 1 million tomorrow. That's his right to do that. What are the ones that have been drawn down on already? What are the ODs that have been drawn down already? So basically, the bank has to be able to manage a reserve, keep aside liquidity, basically, based on those projections. Second thing is the obvious one, operational overhead. So that we can all understand based on the payroll, electricity bill, whatever, they have to keep aside a certain amount of money. For a bank, what do you think the biggest cost to a bank is? Any idea?
Interest expense.
Sorry?
Interest which we need to pay to customers.
No, I'm talking about overheads.
Or
Not related to their business, but generally, what would their operational overheads be?
Payroll, I think.
Sorry?
Payroll.
Payroll, exactly. So biggest cost to the bank, because bank end of the day is a service organization. The biggest cost to the bank will be the people that they hire and the staff that they keep. Yes, there would be overheads for working in office building. There will be overheads for electricity, water, all those things, but those are very small. Biggest cost will be staff. So last 40, I went back to work this after 42 working days, only last Wednesday. I've been working from home throughout with a laptop at home and working from home. So if you really look at it in the last 3 months, we've still had to pay rent and all that for whatever buildings we rent out. But the overheads, what a lot of people have realized is you probably can work at home. You don't need to really work in an office. So those overheads can actually come down. So, but the bank has to maintain a reserve for those as well. Amount of cash flows basically, and that's not unique to banks. Everybody has to do that. But in the case of the banks have to keep that plus additional funding requirements because ultimately it's dealing in money. It's not its product is money basically. It's funding and liquidity and funding. So we know what the SRR is, and that central bank will have an SRR. Bank must still keep part of its deposits liquid for financial obligations. So even if we have kept set 10 aside from a deposit for liquid, we have to make projections based on everything and keep more money than the reserve money aside for that operational expense overheads as well. So what can the bank do? Again, it comes with those cash flow projections. They have to be very efficient. Comes back to the question that came about systems and projections and about being able to manage this efficiently. The more efficiently the bank can manage it, the more maximizing on returns that it can achieve. So for example, it doesn't help the bank if it's keeping ₹1 billion every day sitting in its central bank account because it's scared of breaching its regulations and scared that it might have a liquidity requirement. Which basically means on ₹1 billion every day, he's losing out interest of say 6% annualized overnight. So that's not effective. So the bank has to make sure that it has managed its funds in the most efficient way so that the money sitting idle in its central bank account or any of these accounts that it has as a non-interest bearing account for reserve purposes is very small, is the minimum MCOR required. And to do that, it has to have very effective systems and projections so it doesn't breach its liquidity and reserve requirements. So banks can do that as long as there are no errors that take place. And the more efficient the bank is, the better. Why is the bank doing this? Because ultimately, all of that boils down to the money the bank makes and the return the bank makes overall, and thereby how much confidence is investors have in the bank. Stakeholders for a bank are the shareholders of the bank and the depositors of the bank and the clients of the bank, basically. Borrowers, lenders, and people who buy the shares of the bank. If the bank's shareholders are not convinced of the return that it's making and the strategy it has, it will not buy its shares and the share price won't, move higher. So everything boils down to return. So the more efficiently it manages its reserves and fund and cash flows, the more efficient, more impact it has on its bottom line as well. So factors to be considered when deciding the level of operational reserve. So basically, when you are thinking about how much of money you have to put aside for your requirements, you have to think of a few things. quality of your asset portfolio, amount of risk exposure, capability of raising new funds, concentration of loans and deposit accounts, information systems, geographical diversification. So let's just go one by one. Yeah. So now you are sitting there and you're thinking, okay, now I know what my deposit maturities are. I know what my loan requirements are. I know that people will require me to do this over the next 3 months. Okay. How do I manage my reserves? I need to keep at least X amount of money in my account for this period. Then you determine for yourself, do I keep this money from day one out there, or how can I manage this efficiency? Then you go back to your portfolio. You go back to where you have invested your assets, your funding. And see, this is the portfolio I have. Treasury bills that I have invested in. I have treasury debentures. The debentures I've invested in. I have bought foreign currency. You look at your portfolio, where you have put your money. And that is the first point. The quality of the assets portfolio. So now you have a X amount of reserves or cash flow requirements coming up in the next 3 months. Look at the portfolio you have. What kind of portfolio? Like we discussed in the earlier session, can I sell my 10-year treasury bills in a hurry and meet any liquidity requirements? Or do I have any 3-month treasury bills that I can sell if I need reserves? And can I sell them fast? That. Am I holding high credit rated assets in my book? That means that guys that are really even in a bad situation, people will still want to buy these assets that I have, treasury bills that I have. If it's yes, fine. So you look at the quality of your asset portfolio. But if you're holding things that are very illiquid, no secondary market, very difficult, then you know that will have a difficult time in raising reserves in a hurry. So you need to look at the quality, tenor, risk of that portfolio. Second point, what I just touched on the risk. Is it good quality, bad quality that I'm holding on to? If it's bad quality, then I might have a bad difficulty selling these assets to raise liquidity. Then the third one. Okay, I don't want to touch my portfolio. I want to raise money and pay for these operational reserves or requirements that I have or other requirements I have. But I want to go into the market and do it rather than selling my own assets. I want to go into the money market and borrow. Is my money market liquid enough? Will I have a problem going out and borrowing from the money market? Is there sufficient, do I have sufficient counterpart? Do I have sufficient people to lend to me? That's the third point. Right? And then concentrations of loan and deposit accounts. So can somebody tell me what that point means? Concentration of loan and deposit accounts. Can somebody explain that to me?
It is loan to deposit ratio.
Yes, it could be that. But I'm not referring to that here.
Maybe you might have 10 loans or 10 deposits where the most of like out of total loan portfolio, the deposit portfolio, the most part of them concentrated with few loans or the few deposits, something like that.
Excellent. That's exactly right. So that you're 100% right. It's the 80-20 rule, right? I mean, 20% of your depositors could be giving you 80% of your deposits because you have a few large depositors. What happens if those large depositors don't renew their deposit with you? You're going to have a huge, hole to plug in. If that is the case, how do you then, if you have a reserve requirement and those depositors are not renewing, then you have a problem because then you need to go out and borrow that money. Same with borrowing. If you have a few large borrowers and they don't pay back that borrowing, yeah, or conversely, if they don't renew their loan, if they actually pay it back, then what happens is you have too much money, right, in your books. You don't want that as well. As a bank, you want people to keep on borrowing money and paying their interest on time. You don't want people to pay back their loan. You just want people to pay their interest and principal on a timely basis and meet the obligations, but you would love for them to keep their loan going at the correct rate for the bank. Yeah. So if they say, no, I'm going to pay your loans back, it doesn't necessarily make the bank happy, because now he has excess cash in his hand and he doesn't know what to do with it. So if it's concentrated on a few large lenders or borrowers who can make that swing very fast, or make that change very fast and impact the bank's balance sheet and the bank's assets liability mix basically, and have an impact on its reserves, that is something to watch out for. And then the other one is information systems. So basically it comes back to what I mentioned earlier in terms of having proper systems in place to monitor this, giving you the right information of bought forward balances, projections of cash flows, how much of information you can gather, data you can gather to actually give you the knowledge you need to make projections. What you know, that's fine. But the challenge is knowing and giving you the right information to the right people to make the right decisions. So your asset liability committee, your treasury department should know, your head of corporate banking, your head of retail banking should know, look guys, you have a big deposit that's coming up in the next month. Do you know about this? Do you know that you need to talk to this client and make sure he keeps his deposit? Do you know this client's lending is coming up for repayment? Are we getting this money back? So the information system and the engagement and the dialogue and the conversations that happen between the banks, personnel, comes from a lot from the information we can get out of our systems. So it's very important that the correct information systems and the correct MI is given to the bank people, to management and to the right people, so that makes it easier for everybody to collect data for their decision-making purposes. The final one is geographical diversification. What does that mean from a reserve perspective? Just think about it a bit. You know, what does geographical diversification mean? So basically, look at it this way: it doesn't impact Sri Lanka, we'll say, but if it impacts, like, my bank, HSBC, we have branches all over the world, mainly in Asia, but it's spread across from America to Australia. We have, right? Because we are diversified, we have requirements in all those markets that we are in. So if we have a stress in one market, it does have an impact on that market. But we can always leverage on our presence in, say, another market to assist in that. So for example, in Sri Lanka, if we have a shortage in terms of US dollars and reserves in US dollars, we can always go to a Hong Kong office and get funding from Hong Kong to support us in Sri Lanka. Some of the local banks may not have that same reach, but they can always go to a different market and get. But since we have a presence, if they are present, if you are diversified, you have impacts from those different markets, but you also have, you're not concentration or risk in one place. You have the ability to sell your assets or raise liabilities in different markets to support your business in a different market. So the geographical diversification helps to spread the risk, and your ability to raise funding and do things also has a big impact based on that. Is that clear?
That means we have to hold securities in different regions or different countries, something like that?
That could be one way of doing it, or you could have a presence or a business in that country as well. Okay. Could be both ways. It could be where you are, instead of parking your money in, say, the US only, you could have kept your money in the UK, in other countries, and then yes, you have your ability to liquidate those is better than what you would have in the US, 100% right. Or you could have your business and operations in different countries to diversify the risk. So for example, some of the local banks will have business in, say, Bangladesh or in the Middle Eastern countries. Now, that is a business model, but it also helps to diversify the risk. So if there's a requirement, they could always reach out to those branches as well.
Okay, thanks.
So concentration loan deposit, like I mentioned, no number of deposits, few or more, number of loans, few or more. Information system, as I said, it depends the quality of the information system will determine on whether what kind of approach you take and what kind of cushion you have on your reserves. There are two scenarios they're given here: one branch bank, one bank with 100 branches. Also, which one needs more liquidity? The bank with 100 branches needs more liquidity, but it also has more diversification in the process. Yeah. So slide number 12, operating reserves require vary over time as circumstances change. So basically, it's a very obvious thing. If you start a bank with 5 depositors, now it has 10,000. Obviously, now your requirements will change based on the number of depositors, the volume of deposits increasing. So we are going back into SRRs. We've already touched on it. Basically, cash and liquid assets the bank requires the bank to keep. So the 10% is the SRR that we worked as example. I think currently now the SRR is about 6%, if I'm not mistaken, in Sri Lanka. So this is usually the SRR amount the banks you have to keep on their deposits is usually larger in quantum than the operational reserves. So for example, if a bank maintains SRR operations of 12%, it exceeds SRR of 10%. And if basically the bank maintains a reserve of 10%, it exceeds the operational reserve, it would be otherwise exceeds the 8% it needs to maintain. So basically, it has to keep a buffer above this SRR for reserve purposes, operational reserve purposes. So, okay, so we are done with the session. Any questions around it? It's a pretty easy session. It's just talking about reserves, and we touched on it before. Very short one. Before we go into the questions, anything you all want to clarify?
This is just a common. I'm asking an opinion. Normally,
Sure.
How much of reserve for operational payments or other payments bank would keep as a percentage? If you take
As a percentage, I would think about 1 or 2% above, but honestly, I don't have a number to give you, to be honest with you.
Is there any uniformity in the world that normally banks would keep this percentage of reserve for their operational
No,
transactions?
not really. Not that I know of. I think what happens is it all depends on the bank's own cash flow requirement. What is required is capital adequacy requirements. So capital adequacy is the most, basically there are liquidity ratios that the bank has to maintain. Liquidity ratios go into a lot of detail as to what kind of liquid assets you can have as well. So not just liquidity ratios of saying 10%, 12% liquidity, but it'll tell you based on this Basel framework, etc., how much of liquid assets, what type of liquid assets you should have. That's one thing. But that is mainly, again, looking at the deposits side. Operational reserves are very much something determined by finance.
Okay.
And they look, okay, this much of money funds we need for running the business. Therefore, we need to keep X amount as a reserve. But there is no ratio as such that I've seen saying operational reserves has to be this much or whatever. What is looked at is capital adequacy reserve. So when you maintain all that and look at your in and outs and your cash flow position, you automatically maintain the operational reserve.
Right. Right, and this is regarding the money supply that you the show. I mean, that I should have asked that question earlier.
Sorry, I can't hear you. If you don't mind, a little louder.
Yeah, I should have asked this question earlier when you did.
No, that's fine.
This is money supply. But now you took an example and show that how money supply will happen when the bank lend when a bank get a deposit and lend 90% of it.
That's right. Yes.
What is the percentage you said that incremental percentage that will happen? Take one quantity.
It depends on how many times that gets rolled, right? So if a deposit ends up with the bank and it goes 1 time, 2 time, 3 time, 4 time, it will depend on, one is the amount of reserve you need to maintain, and 2, how many times it's on lent at. So it could be 10 times over, it could be 5 times over, depending on the situation.
Have somebody done something that how many times that it would be rollover?
Yeah, I think the multiply, if you look at it, is 6.7 times. It's on that slide. If you look at it, I think based on that, it was like 6.7 times.
All right. Okay. Thank you. Thank you.
So let's go back to the questions. Amount of operation is determined by who determines the operational reserves for a bank.
Commercial banks. B.
The bank itself, yes, correct. Right. Purpose of operation is to what? Purpose of an operational reserve is to
C. Provide for financial payments and overhead.
That's right. Which bank needs the most operational reserves? One branch bank, automated bank, bank with 1 million customers, manual system bank. It's a bit of a vague question, but yeah, what would be the likely answer?
Manual system bank?
I think yes. Because why is that?
Because you have to deploy a lot of employees to manage the operation.
That's right. Because your overheads increase, right? Basically, automatically. It's nothing to do with your geography or the number of customers you have or anything like that. It's just purely lack of technology more than anything else. Yeah. Legal reserve requirements are constant from country to country, set once and never change, set by the commercial bank, set by central banks.
Set by central bank.
Yeah, correct. Not only central banks really, but there are other institutions as well, but broadly central banks. That's all. But I'm happy. Okay, just go back and recap before doing that. The basic idea behind this session was to give you a more in-depth outline of the reserves, operational and legal reserves. So basically to make you understand that the bank has obligations in terms of the reserves it has to make given by the regulator, as well as it has to also manage reserves for operational requirements like any other organization as well. And then we went into the factors that determine what kind of operational reserves they have to maintain outside of the legal requirements based on their cash flow projections and portfolio mix and the risk that they have, geographical spread and the information they have, information technology they have, information systems they have, etc., etc. So basically, it's a decision that the bank will make based on the data they have in their hand and also the legal requirements they have. So a more manual intensive bank will have more operational requirements and also more risk, because if it has more manual systems, that means it is taking more risk and it may not have the correct information on it as well. So it has to basically rely on a lot of manual data points, which can lead to operational risk. So reserves might be more. The more efficient you have, the more technology you use, and the more automated you are, and the more real-time information you can provide, the less of operational reserve you might have to maintain because of less people, less employment, plus the ability to fine tune and come up with a more efficient sort of projection on your requirements. And then we went into the legal side where central bank requirements are there. Any questions on that section or any other section?
This actually you have explained as SRR. It's unique decision taken by each country, and there again, do we have any standard, say best standard, like we have reduced recently. Normally developed world, what would be the rate they would apply?
Now, for example, in some countries like the US and stuff like that, it might be 1 or 2%. In other countries, in the countries where there is a high degree of money supply and there is a control, it could be higher. It could be like 10, 12% or more.
So is there any relationship between the stability of the financial stability of the country with the SRR?
It can have an impact, yes, because ultimately, why is SRR used? If you go back, SRR is used to manage the money in circulation, basically. So money in circulation is basically money supply. Money supply basically means that the amount of money in the hands of people. If the amount of money in the hands of people is leading to people purchasing things more, it can lead to inflation. Inflation can basically mean cost. Basically, inflation is cost of goods and services going up. If inflation goes out of control, basically it's very difficult to maintain stability in the financial system. So central bank manages inflation on an inflation targeting basis. Their rate is supposed to be between 4 and 6%. As long as it's within that range, in Sri Lanka at least, they are okay. In the US, they have inflation target of 2%. They need to achieve that. In the last few years, just before this whole COVID thing, things were recovering. But before that, inflation, they were struggling to get inflation up to 2%. They finally managed that, I think, in 2018. In Japan, inflation basically is still at almost 0%. That's why they have minus interest rates and really no SRR, right? So what it means is, yes, it is used as a tool to basically stimulate or bring down the stimulation of a financial system as well. SRR is used for that. So SRR is used for that. Repo, reverse repo rate, monetary policy interest rates are used for that. Central banks bond buying programs where they pump in money by going in and buying bonds in the market or selling bonds is used for those purposes. So yes, SRR is one of those tools. It will depend on the economic situation of that country at that point in time and where the country's interest rates are as well at that point in time, and the amount of money in circulation in terms of printed money as well at that point in time.
Okay, and as far as the legal reserve is concerned, you said other than central bank, other institution also impose that in Sri Lanka. Have we come across that situation?
No, but basically when I say that, it could be like, for example, the Basel Committee.
Okay,
when
right.
they have Basel 2, 3, 2.5, all that, they could have capital adequacy requirements, right? That means that you need to maintain certain amounts of capital, which means that you are going to think twice before giving out deposit lending to certain people who have certain credit qualities. You might keep a higher interest rate, which basically can have an impact on who you can lend to, or certain deposits, for example, can't be classified as liquid deposits because they are only for 1 week or 2 weeks. So those are not direct reserves, but they have an impact on how you look at the quality of your portfolio at the end of the day.
Got it. Yeah. Okay.
Yeah. Okay. So one question I have for you all, was the presentation too fast today, or how did it go through? Because you must give me some feedback, because I don't have you all in front of me and it's very difficult for me to gauge your level of understanding or whatever. Thank you for all the questions I got. I really appreciate that. But could you give me some feedback if you don't mind? Was it too fast? Should it slow down a bit? Is the pace okay? Is there anything else that you want to provide feedback on?
So since you have given opportunity to ask question, so I believe anyway that others have to comment that I feel the phase is okay because you give time to time, you check from the students whether we understood the context.
Okay, good, good. Anybody else? Any comments?
Basically,
I
it's
would
okay.
add,
Yeah.
Sorry, I didn't get it.
yeah, I would agree with that comment, sir, because since you provide enough time as to question and time to time you ask whether the concept is understood correctly. I think
Yeah.
no worry about the this space is good, like you can
Okay.
understood very well. Thank you.
Right. And in terms of the material you'll have, if you'll need any more detail on that, please do ask. This is the material we have, and I would encourage you to do some of your own research on it. We will have an assignment for you, I think, somewhere towards the end of July. There will be 2 assignments for this program. First one was due in April, but obviously, given the situation, that didn't happen. But we will have an assignment somewhere towards the end of July or so on whatever topics we have covered up to now. And if there's anything outside of the presentation that you all want to discuss, please feel free to ask those questions as well as you have done today.
This is directly relevant to the exam, even though it's not that important. Like in this section, are we getting the essay type of questions, or is the multiple choice questions or anything different?
Well, I think the first thing was supposed to be an essay type question with assignment. We were looking at it as a group assignment at the beginning, but very honestly, given the current situation, we need to reassess that and come up with whether we are going ahead with that or changing because of the current COVID issue. But we were looking at a group assignment as a first assignment as well. But we'll let you know what that is. But it will cover the content that's given here either way. I don't think it will be a MCQ.
Any recommended text that you would, to look into the general, say recommended text to, to further know the subject other than this.
In terms of reading material, is it?
Yes, like, from your
Okay,
experience.
let me come back to you with reading material. I think what I will do is I'll need to check with Nishanta also on what exactly he has covered from where, and maybe we'll recommend a few articles and books and stuff like that that you guys can have a look at to better understand the subject as well. Yeah.